Welcome to the final part of our audiobook series on reading price charts bar by Al Brooks. In this episode, we'll cover chapters 11 to 15, the concluding chapters of this detailed and insightful guide to price action trading. These chapters dive deep into trading ranges, breakouts, trend reversals, and key strategies for managing entries and exits. Al Brooks masterfully explains how to interpret the market's language, bar by bar, and offers valuable techniques to improve timing, manage risk, and increase consistency in your trades. Whether you're a seasoned trader or just starting out, this final section wraps up the book with practical tools and nuanced market understanding that can take your trading to the next level. Stay tuned, take notes, and don't forget to subscribe to Trading for Life for more expert trading content and audiobook summaries. Let's dive in. Chapter 11, The First Hour. The best trades initially are usually related to patterns from yesterday, and you first need to look for failed breakouts, breakout pullbacks, trends from the open and their first pullbacks, and then common price action patterns. Although there is a tendency to think that the patterns are different in the first hour, the reality is that from a price action perspective, they are not. The setups are the same as during any other time of the day and on any time frame. What is different is that the volatility is often greater, and therefore the patterns run further, and the reversals are often unexpectedly abrupt. It is common for reversals to look weak and have 2 or 3 doji bars before the trend breaks out. Realize that this is common, and if you entered and see this weakness, don't scratch out. Rely on your read because you will likely be right, and you stand to make a large swing profit. If the bars are larger, to keep his risk the same, a trader needs to trade fewer contracts. Market is moving quickly, and it is difficult to spend time doing exact math while trying to read the charts and place orders. Just quickly cut the position size in half or 2/3. It doesn't matter what you do. What matters is that you do it quickly. Stop thinking about it and concentrate on what is much more important, reading correctly and placing your orders. One other difference about the open is that many trades set up based on yesterday's price action. There will often be a large flag that develops in the final couple of hours of yesterday, and then a breakout occurs on today's open, or the market gaps well beyond the flag. In either case, watch for reversals and continuations. A final important difference is that the high or low of the day occurs in the first hour on most days, so it is critical to swing part of any trade that could be a major high or low, and use a break-even stop to allow yourself to collect the windfall profits that often happen off the open. The first hour or two of the day is often rich in reliable trades. On most days, there are 1 or more tradable reversals, usually with several opportunities to re-enter after scalping out with a profit. Occasionally, a trend will develop from the first bar or two and run for an hour or more without a pullback, a trend from the open or trend from the first bar. But traders should always be looking for a reversal in the first hour or so because they are the rule and not the exception, and they commonly lead to a protracted trend. On most days, there are 1 or more tradable reversals in the first couple hours of the day. Why does the market open and then make a big move over the next several bars and then reverse? Why doesn't it simply open at the low or high of the day? The location of the open of the day is not set by any firm or group of firms, and instead represents a brief equilibrium between buyers and sellers at the instant of the open. If the institutions have a large amount of buying planned for the day, why would the market ever open above yesterday's close, and then sell off before rallying to a new high? If you were an institutional trader and had a lot of buy orders to fill today, you would love the market to open above where you wanted to buy, and then have a sharp move down into your buy zone where you could aggressively buy along with all the other institutions who likely also have lots of similar buy orders from their clients, and then hope to see a small sell climax that will form a convincing low of the day. If the reversal backup is strong enough, very few traders will be looking to short, because there will be a general feeling that the upward momentum is sufficiently strong to warrant at least a second leg up before the low is tested, if it gets tested. Would there be anything that you, if you were an institutional trader, could do to make this happen? Yes, you could buy into the close of the pre-market to push the price up and fill some of your orders. Not as much volume is needed in futures or stocks to move the price before the 6:30 a.m. PST open. Then, once the market opens, you could liquidate some or all of your longs and even do some shorting. Since you want to buy lower, you will not start buying until the market falls to an area that you consider to represent value. price action is very important. You would like to see how the market responds once it gets down to some key price, like the EMA or a prior swing high or low or the low of yesterday. If the downward momentum begins to wane and if the market starts to reverse up from the key price, you will liquidate any shorts and aggressively buy to fill your orders. Since most firms will have similar orders, the market will start to rally. If you believe that the low of the day might be in, you will continue to buy as the market rallies, and you will aggressively buy any pullback. Since your order size is huge, you don't want to buy all at once and risk causing a spike up and then a buy climax. Instead, you would rather just keep buying in an orderly fashion all day long until all of your orders get filled. Is this what actually happens? Traders at institutions know if this is what they do, but no one ever knows for certain why the market reverses on any given day. Also, reasons are irrelevant. All that matters is price action. Reversals often happen seconds after a report is released, but an individual trader is unlikely to understand how the market will respond to a report by simply watching CNBC. The market can rally or sell off in response to either a bullish or bearish report, and a trader is simply not qualified to reliably interpret a report in the absence of price action. The best way to know how the market will respond is simply to watch it respond and place your trades as the price action unfolds. Very often, the bar before the report is a great setup that gets triggered on the report. Place your order and then your stop, and trust your read. Opening reversals often happen quickly, and the sharpness of the reversal makes it difficult to understand the fundamentals. If the market was so bearish a couple of minutes ago, how can it be so bullish now? Don't give it any thought. Instead, just look for standard price action setups and trade them mindlessly without giving any consideration to the reasons why the reversal is taking place. All that you need to know is that it is in fact taking place and you must enter. Although the 5-minute chart is the easiest to read and the most reliable, the 3-minute chart trades well, particularly in the first hour. However, it is prone to more losers, and if you like the highest winning percentage and don't want the negative emotion that comes from losing, you should stick to trading the 5-minute chart and work on increasing your position size. As a trader, it is best to keep your analysis simple, especially in the first hour when the market is moving quickly. The vast majority of opens are related to the price action of the final hour or so of the prior day and take the form of a breakout, a failed breakout, a breakout pullback, or a trend from the open, and any of these can move very fast. Patterns related to the pre-market. When looking at tick or volume charts of the Globex, the open is not easy to spot because it is just part of the 24-hour trading day and appears indistinguishable from the rest to the chart. There is a tendency for Globex highs and lows often to get tested in the day session, and there are patterns in the Globex that get completed during the first many bars of the day session. The first hour or so usually moves quickly, and the day session alone provides great price action. Since most traders are not capable of trading two charts well, especially in a fast market such as after the open, just watch the 5-minute day session. Most trades that set up on the Globex chart will have price action reasons for the same trade based on the day session alone. You should be willing to miss an occasional trade rather than risk losing money while being confused as you quickly try to analyze two charts while you place entry, stop, and profit target orders. Bar 1 in figure 11.1 on both the Globex chart on the left and on the day session chart on the right is the 640 AM PST bar. The Globex had a failed flag reversal by signal, and the day session had a strong bull reversal bar that was a breakout pullback above the two-legged up move into yesterday's close, and a possible bull trend from the open. Remember that if the first bar of the day is a trend bar, it is usually a setup for a scalp. If it fails, especially with an opposite trend bar, it is a setup in the opposite direction. Nothing was gained by watching both charts, and trying to do so increases the chances that you will not be quick enough to take all of the available trades and make mistakes in your order placement. Patterns related to yesterday. Breakouts, failed breakouts, and breakout pullbacks from yesterday's swing highs and lows, large flags, trend lines, or trading ranges are the most reliable patterns in the first hour. These setups usually lead to one extreme of the day and therefore are important swing setups for at least part of the position. Try to anticipate setups before the market opens based on yesterday's price action. As you can see from the huge volume, the best traders in the world are taking them, and so should you. Many trades in the first hour are related to patterns from the prior day, and lots of large traders base their entries off daily charts and the high, low, and close of the prior day. For the open, look at the final hour or two of yesterday and see if there was a strong trend or a trading range and therefore a trend line, or if there was a trend line break and a test of the extreme is now likely, or if there is a possible 3-push pattern or a trend channel line test setting up. The market often tests yesterday's high or low in the first hour, resulting in a tradable breakout pullback, or a reversal. The 5-minute OIR chart yesterday in figure 11.2 had a 3-hour, 2-legged rally that broke the major bear trend line not shown after morning selling, and the rally overshot a bear trend channel line twice, reversing down both times, bars 4 and 5, showing that the bulls were losing control. The length of the rally is evidence of bullish strength. A 2-legged countertrend move in the final hour or two that breaks a major trend line is a common pattern. It alerts you to look for a trend reversal on the open in the form of a higher low or a lower low. Today, the market gapped down and quickly traded below yesterday's low, where it formed a strong bull reversal bar. This large bear flag failed breakout occurred over 2 days and provided an excellent long entry at 1 tick above the high of the bar 7 signal bar. Opening reversals that reverse the high or low of the prior day often form the high or low of the day, so traders should swing some or most of their contracts. Since one extreme of the day usually occurs in the first hour or so, it is important to swing some or all of your shares. Here, a break-even stop would have allowed a trader to make as much as $5 on a swing to a new swing high above bar 5. When the open forms a breakout of a pattern from the prior day's close, traders should enter on a failed breakout setup, like bar 7, and then enter in the opposite direction if the failed breakout fails and becomes a breakout pullback. Here, there was no good breakout pullback short because the move up from the bar 7 low was strong. A second entry short would be worth taking, but there was only a low 1 and not a low 2, and the low 1 led to the bar 8 high 1 long. But on a smaller scale, bar 8 was a breakout pullback long on the pullback from a new high on the day. Obviously, the EMA in the first hour can be misleading when the market opens far from it, but then reverses strongly. For example, the EMA is falling yet the market is rising strongly. Although the EMA is often helpful in the first hour, the price action is more important, so do what the market is telling you, and not what the indicator is saying. The market gapped up into a bull trend bar at bar 5 in figure 11.3, creating the possibility of a bull trend from the open. Instead of breaking above bar 5, the market broke below its low, creating a double top twin and a bear trend bar. When either of the first bar or 2 of the day is a strong trend bar, it usually leads to at least a tradable scalp and often a good swing. The early longs who bought bar 5 were stopped out below its low, and when the second bar closed as a strong bear trend bar, the longs would likely wait before looking to buy again, and the odds of a profitable short were therefore high. It would be very unusual for back-to-back opposite trend bars on the open to both fail to yield at least a scalp. Yesterday closed with 3 pushes up after a sharp rally, effectively a wedge, and this commonly leads to a deep pullback that tests the lows and then rallies to a new high above the wedge. The sell-off down to bar 4 had enough momentum so that a failed test of the prior bar 3 high was likely, normally, a lower high, and it would have been a good short for a second leg down, which is common after a wedge top. The market gave a higher high test on the open at bar 5. Although the wedge did not sell off much else down to bar 4, bar 5 can be looked at as a second attempt to get down to the beginning of yesterday's rally. Remember, everything is gray, and although a wedge does not typically fail, the upside breakout to bar 5 was the failure because it extended above the top of the wedge. Here the failure failed, and failed failures are usually good entries. Always think about what is going on. Wedges usually don't fail before having at least a 2-legged correction, so when the market gapped up and formed a bull trend bar, the bulls were excited. However, on the very next bar they were stopped out, and smart traders saw this as a failed failure and shorted. Bar 6 was a failed micro trend line break in a steep bear, so was a short. Bar 7 set up a bear M2S short. Bar 8 was the deep correction that price action traders were looking for since the Bar 3 wedge. It was also 2 legs down on the day and a test of yesterday's low. Bar 8 was a great second entry long. Bar 9 was another chance to buy since it was a failed low 2, which usually results in at least 2 more legs up to form a possible low 4. This was a great trade because it trapped bulls out of a strong up move, and they would then have to chase the market up. A trap like this is common at the start of a strong trend and is a sign that the trend will likely go far. Bar 10 was a strong up leg that broke the trend line and broke above the EMA and had many bull trend bars, so a higher low was likely to follow. Bar 10 was also an EMA gap bar gap above the EMA with a bear signal bar, and it is reasonable to assume that it would be good for at least a short scalp. However, at this point you would be looking to buy a pullback, since the trend is up until proven otherwise. Bar 11 was a failed breakout from a tight trading range, and it broke a trend line. Bar 12 was a failed failure. After the failed breakout of the top of the tight trading range, the market now appeared to be failing on its breakout of the bottom. The market formed 2 small bear trend bars en route to Bar 13, and this is effectively a 2-legged correction from the Bar 12 reversal up. You could buy on Bar 13, above the second bear trend bar, or you could buy on Bar 14 after the inside bar that acted as a breakout pullback. There was no pullback when the market broke above Bar 10, indicating that the bulls were strong. You could look for a high 2 on the 1-minute chart to go long or wait for a 5-minute pause or pullback. Bar 15 is not a good long because it was after a small bear trend channel line breakout and reversal. Also, the setup bar was too big, and its high was too high. Buy low, sell high. Bar 16 was a high too long on the breakout above the small inside bar, which allowed for a tight stop. Apple closed yesterday with a tight trading range in figure 11.4, which could be a setup for a failed final flag. On Bar 3, Apple quickly tested below the bull flag from yesterday's close and then broke out of the top. However, it reversed back down on the next bar. Although this is a decent failed final flag short entry, the momentum was strong, and the original failed breakout through the downside means that it might be better to wait for more price action before entering. At this point, a failed flag breakout and a reversal of yesterday's high make a bear case more likely. Bar 5 came at the end of a barbed wire pattern that trapped bulls into buying a high 2, and was a great short entry at 1 tick below the low of the high 2 signal bar, the prior bar. This 1 bar would trap the bulls long and force them out. Barbed wire often has a second reversal, so you have to be prepared to reverse. Bar 6 was a signal to reverse to long, because it was a failed breakout and a second leg down to the EMA in a bull. Most bars are above a rising EMA. Note that the sell-off to Bar 6 broke a trend line, indicating that the bears are willing to become aggressive, so you need to be prepared for a failed test of the bar for top of the bull. Bar 7 was a reversal bar that failed in its breakout to a new high, and it was the second failed attempt to break out above yesterday's high. Bar 4 was the first. Since the range of the day so far had been only about half of that of a typical recent day, there was a good chance that a breakout in either direction would double the range and likely have at least 2 legs. The trend traders would likely be confident enough to make at least a second run after any pullback. The Bar 7 double top and third push-up in the bull was the top of the day. Bar 9 broke below the Bar 6 swing low but not the low of the day, so the odds were very high that there would be at least 1 more push down to test that low, which was a magnet and very close. Bar 10 completed a barbed wire pattern, but since everyone was confident of a second leg down and a test to a new low of the day, it offered a great M2S short below the small inside bar. It was also a breakout pullback from the breakout below Bar 6. The barbed wire pullback to Bar 10 broke a minor trend line not shown, so it might be the correction that ended the first leg down, but the momentum down has been so strong that the bulls would not be confident enough to buy aggressively yet. They would need more price action. Break to the Bar 11 new low of the day was essentially straight down, and therefore likely not the end of the move. Traders will look for a second leg down to at least test the Bar 11 low. Since it was a failed breakout of a bear trend channel line, 2 legs up were likely first. Bar 12 was a double bottom pullback long and a failed low 2, but in the absence of a prior good trendline break or a strong reversal bar, it would only be a scalp. Also, Since a second leg down is likely, it would be much wiser to focus on getting short again, or adding to shorts, than allowing yourself to be distracted by a small bull scalp after 7 sideways bars with big tails. Bar 13 was another M2S opportunity for the bears, but the rally to the EMA broke a good bear trendline. This is a signal to both the bulls and bears that the next reversal up from a new swing low has a good chance of having 2 legs up, if the reversal is strong enough. Bar 14 was another M2S short. Bar 15 was a break to a new low, and it had a strong bull reversal bar off the new low, and it overshot 2 bear trend channel lines. Since it was a spike and channel down, a test of the bar 14 start of the channel was likely. It was also the second leg down from the first trend line breaking pullback to bar 13. Finally, it was the second leg down from the high of the day. All of these are signs of strength and increase the odds that the rally will have 2 legs. Second leg ended at bar 16, which broke above the high of the first leg and reversed, and it failed to break above the bar 14 high, forming a double top bear flag with bar 14. Incidentally, when there is a strong move that ends in 3 pushes, and then sells off with less momentum, shallower slope, smaller trend bars, more tails, the odds are high that the high of the 3 pushes will be exceeded shortly because this is likely a higher time frame higher low. The market fulfilled its bar 7 objective on the open of the next day. Yesterday in figure 11.5 was a bull trending trading range day or a trending stairs day, but had 3 pushes up and walked up a trend line, which usually means that a trend line break is imminent. The market broke the trend line with the gap opening, and bar 1 was a breakout pullback short, and it might be the start of a bear trend from the open. Bar 3 tried to form a failed breakout, but there were too many overlapping bars on the way down and no climax bottom. There were 3 pushes down to bar 3, but the pushes were small, and there was no prior bear trendline break. Bar 5 tried to form a double bottom with yesterday's low to the penny, and instead led to a small wedge rally that formed a double top bear flag at bar 6. Double top bear flag is a common setup after an initial down move off the open, especially in stocks, and is often followed by a protracted bear trend that is often a trending trading range bear. The bar 6 signal bar was an EMA gap bar. Bar 7 was a breakout pullback short even though the breakout had not yet developed. Close enough. It was also a failed double bottom pullback, a successful double top pullback setup, and a micro trendline short. R9 was a 2-legged breakout pullback from breaking below yesterday's and today's lows. Yesterday's day-long bull trend was actually just a large bear flag, and today was the bear trend that came from its breakout. Yesterday, in figure 11.6 was a strong bear, but bar 4 broke above a major trendline, indicating that the market might try to reverse after a test of the bar 3 low, usually a 2-legged drop. Instead, the market sold off in 2 legs into the close. Bar 8 broke above the new, flatter major trendline generated by the bar 4 rally, and then had a small 2-legged breakout pullback to the EMA at bar 9, 2 bear trend bars separated by a bull trend bar. This breakout pullback led to a trend from the open bull. It was also a higher low and the start of the second leg up from the bar 7 trend channel line overshoot. Bar 10 was the third push-up 3 trending trading ranges, so a 2-legged pullback was expected. Bar 11 tested the low of the prior trading range and was an 11:45 a.m. PST sharp move down to trap bulls out of the market. It formed an EMA gap bar long that was also a high 2, and this final bull leg broke out of the top of the third trading range and extended to almost a measured move up into the close, twice the height of the bar 10 to bar 11 sell-off. Bar 1 in figure 11.7 was a sharp pullback to test yesterday's strong close, and it quickly reversed up, creating a buy entry at 1 tick above the high of bar 1. Bar 4 is a breakout pullback short setup. The open generated a lower low after the bar 3 lower high, and bar 4 set up a low too short. Bar 5 followed the lower low test of the bear low that formed yesterday after the bear trendline break. Today opened up and traded down to test that lower low. The breakout pullback entry above bar 5 was effectively a high 2 since bar 5 was the second leg down. Yesterday's close was the first leg. The small bar 6 lower high and then trendline break resulted in a breakout pullback short. The entire prior day was a large bear flag and a double top bear flag with the high of the day before. Bar 7 was a wedge-long setup, a failed breakout below the bear trend channel line and below yesterday's low, and the wedge followed a break of a major bear trend line. Bar 8 was a two-legged breakout pullback from the strong rally up from bar 7 that broke a bear trend line. Since a second up leg was likely, traders would look to buy. The easiest entry was the high 2 at bar 9, Amazon, breakout pullback long. Bar 1 in figure 11.8 is a double bottom pullback in a large breakout pullback after the market broke above the bear trend line from yesterday's close. This is a good entry into the higher low that followed the trendline break. Bar 2 is a wedge short, a failed final flag, and a lower high. Opal, breakout pullback long. Bar 3 is a high 2 long on a second test of the EMA after the market gapped above yesterday's bear trendline and then pulled back to the EMA. Whenever there are 3 or more overlapping bars, it is better to wait for a second entry, like a high 2. Bar 4 is a wedge short and a failed breakout of yesterday's high. Rim, breakout pullback long. The market broke above yesterday's high, and then bar 5 formed a high 2 breakout pullback long at the EMA and a possible bull trend from the open. Bar 6 was a two-legged EMA gap pullback long. FCX trend from the open. The market had a large gap up and then went sideways for several bars, setting up a high 2 long entry above the bar 7 Roman 2. Bar 8 was a wedge short. E-mini failed breakout. The E-mini broke below yesterday's large bear flag but then reversed up at the bar 9 second entry, which was also a small failed final flag. Bar 10 was a failed final flag short above yesterday's high. Doug failed breakout. Bar 12 was a double top bear flag, and with the large gap and no immediate pullback the day was a possible bear trend from the open. The market strongly reversed up on a report and formed a small higher low at bar 13. Bar 14 was a wedge short near yesterday's close. Trend bar on gap open, first or second bar. If there is a gap open and the first bar is a strong, small tail, good size bar trend bar, trading its breakout in either direction is a good trade. If you enter and your protective stop is hit on the next bar, reverse for a swing trade because the market will usually move more than the number of ticks that you lost on the first entry, and there is always the possibility that it could develop into a trend from the open day. Even if there is not a gap open, a trend bar for the first bar is a good setup for a trade, but the chance for success is higher if there is a gap, since the market is more overdone and any move will tend to be stronger. The first bar of the gap down day is a bull trend bar. The long entry in figure 11.9 on the next bar turned into a one-tick failure and then a reversal down. You had to reverse at your stop, one tick below the low of the bull trend bar. Usually, the second entry will more than make up for the loss on the first trade. Gap openings, reversals, and continuations. A large gap opening from yesterday's close represents extreme behavior and often results in a trend day in either direction. It does not matter whether or not there is also a gap on the daily chart since the trading will be the same. The only thing that matters is how the market responds to this relatively extreme behavior. Will it accept it or reject it? The larger a gap is, the more likely it will be the start of a trend day away from yesterday's close. The size, direction, and number of trend bars in the first few bars of the day often reveal the direction of the trend day that is likely to follow. Sometimes the market will trend from the first bar or two, but more commonly it will test in the wrong direction and then reverse into a trend that will last all day. Whenever you see a large gap opening, it is wise to assume that there will be a strong trend. However, sometimes it might take an hour to begin. Make sure to swing part of every trade, even if you get stopped out of your swing portion on a few trades. One good swing trade can be as profitable as 10 scalps, so don't give up until it is clear that the day will not trend. The gap should be looked at as if it were one huge, invisible trend bar. For example, if there is a large gap up and it is followed by a minor pullback, and then a channel type of rally for the rest of the day, this is likely a gap spike and channel bull, with the gap being the spike. These 3 days in figure 11.10 each had large gap openings, gaps from the close of the prior day, and bars 1 and 9 were also gap openings on the daily chart. Bar 1 had a shaved top, no tail at the top and became a large bear trend bar, which is a good scalp setup if the first bar of the day is a strong trend bar, as seen in the thumbnail, especially on a gap opening. There will usually be follow-through, and it was followed by a second large bear trend bar. On most days, this would lead to a bear trend day, and it did here as well, a bear trend from the open. There was a sharp rally to bar 3 that tested the open, but this failed breakout pullback. The attempted bull reversal up from bar 2 failed, resulted in a lower high or a double top, and then a lengthy down move. Bar 6 was an EMA gap bar, a failed breakout of large bear flag that formed in the final 2 hours, and a failed bear trend bar from the open. A short based on that bear trend bar would be risky, since it is in the area of the trading range of the final hour of the day before. It would make more sense to wait for a second entry, which did not come, or a failure, which happened after the bar 6 signal bar. The sharp rally up to bar 7 tested the close of the prior day, formed a lower high and failed, and became a breakout pullback and a double top bear flag with the last bar of yesterday. Big up to bar 7. Big down usually ends in a trading range, as it did on this day. Bar 9 gapped below the low of the prior day and formed a bear trend bar, but it had big tails. It could be the start of a trend from the open bear. The second bar was a second bear trend bar with a close on its low, indicating that the bears were strong. Most traders would short at 1 tick below that low. The very next bar was the entry bar for the short, but it became a bull reversal bar. However, the protective stop above its high was not hit, and a 2-point protective money stop was also not hit, and a scalper would have taken partial profits on his short at bar 10. Bar 10 was also the second leg down from the bar 7 high, which can lead to a reversal. The first 4 bars of the day were largely overlapping, forming a tight trading range, so trading breakouts is a risky proposition. A tight trading range is like barbed wire, and it acts as a magnet, drawing breakouts back toward its middle. The best thing to do is to fade small bars near its extreme, fade failed breakouts, and look for breakout pullbacks. This day had all 3. There was a small inside bar after the bar 10 breakout to a new low and a high 2 variant buy setup, and this is an acceptable long, but with 4 of the first 5 bars of the day being bear bars, this was not ideal. At this point, it was a failed breakout below yesterday's low. Bar 11 was a breakout pullback, the breakout below yesterday's trading range, and a bear M2S. This M2S broke a small bull trend line at bar 12 and reversed back up, setting up a breakout pullback long above the inside bar that followed bar 12. A market that turns up from a low 2 often rallies for at least 2 more legs, and since big gap days often become trend days, this could be, and was, the start of a big move. Trend from the open or trend from the first bar. Sometimes the first bar of the day forms the high or low of the day, and the day begins a trend from the very first bar, a trend from the first bar version of a trend from the open. The trend can also start from the second bar, or even after a few sideways bars, and still qualify as a trend from the open. This often leads to a strong trend day, and if you miss the entry on the open, look to enter on the first pullback. The market gapped below yesterday's low in figure 11.11 and broke out of a large trading range formed over the second half of yesterday, a head and shoulders bear flag. The first bar today was a bull trend bar, which usually leads to a partial gap closure. Many went long on a stop at 1 tick above the high of the bull trend bar. However, the market trapped those longs 2 bars later when it traded below the low of the bull trend signal bar and the entry bar. Bar 1 provided a great opportunity to go short at 1 tick below the low of the bull trend bar because this is where most of those trapped longs will get out, driving the market down. It was a breakout pullback short. Also, any potential buyers will be waiting for more price action, so there are only sellers in the market, making for a high probability short. Shorts added on at the bear flags along that way that trapped other early longs. Bar 2 appeared to be a failed low 2, but it did not hit the protective stops above the entry bar, and smart traders are holding short on a bear trend day. There was no strong reversal bar or good prior trendline break, and the down momentum from the open was strong. Also, this was a bear barbed wire pattern, and the odds favor a downside breakout. The presumption was that this is a trend from the open bear day, which is a very strong trend, and therefore smart traders will try to stay short. Also, many traders would hesitate to short the low 2 because it followed a bull outside bar. They would be happy to wait for the second entry, which came below bar 2. This bar 3 flag is the second down leg of the day, and the market often tries to reverse after 2 legs, making the bears more cautious and the bulls more daring. However, once it failed, everyone expected at least 2 more legs down, which they got. The bar 4 flag was the end of the first small leg down, and the second leg ended 1 bar later. This created a small 3 pushdown pattern, and then a small 2-legged test of the EMA. But in strong bear trend days, it is often wise to ignore the buys to make sure that you catch the shorts. Bars 4 through 5 formed a failed final flag that grew into a wedge bear flag. The first leg of the wedge is the bar 4 high, and the second leg is the bottom of the reversal out of the failed final flag. The other 2 pushes up are the 2 small legs up to bar 5. This wedge became a larger failed final flag, as it often does. Smart bulls would only begin to look to buy after the bar 5 rally to the EMA broke the bear trendline. Bar 6 was a 2-legged drop to a new low, giving a high 2 lower low buy entry. Bar 7 was a higher low entry, a high 2, and a failed micro trendline breakout, and was a good buy because even the bears are looking for at least a second leg up. The large bear trend bar 3 bars earlier was a great bear trap, making lots of traders believe that the bears had regained control. However, it was followed by 2 dojis, meaning that there was no conviction to the selling, and it simply trapped longs out of a great trade. This flush out to a higher low could be the start of a new bull, or at least a 2-legged countertrend move up. Note that the second and fourth bars after entry were pullback bars, a low 1 and a low 2. That would be unusual for a bull with conviction, and it told everyone that much more bullish price action will be needed before a protracted bull leg unfolds. However, a failed low 2 in a bear usually results in 2 more legs up, which happened over the next several bars. This keeps bears on edge and will force them to take profits quickly. The first area where they will take partial or full profits is above a prior swing high. After a second leg up to a new swing high, the market failed at a low 4. The bulls took profits and were unwilling to buy again until there was significant bullish price action. New shorts off the second failed swing high feel confident that the bulls won't overwhelm them soon on this bear trend day, and they will continue to sell as the market drops. This resulted in 7 consecutive bars that the bulls could not own. Bar 1, in figure 11.12, is the breakout below the 5-minute signal and entry bars. Bar 2 broke above a 2-bar micro trend line, forming a high 2. This trapped eager bulls who covered on the next bar, 1 tick below the entry bar, and this created a low 2. The low 2 was a great entry for bears because not only was it a with trend low 2, but there were also clearly newly trapped longs who wouldn't be eager to buy once they sold to cover. This resulted in a large bear trend entry bar with several bear trend bars following it. There were only bears in the market at this point, after both the 5-minute bulls and then the 1-minute bulls were forced to liquidate. Bulls now would be waiting for much stronger price action evidence of a reversal before buying again, and shorts would be adding on, believing that any blip up would be temporary and that there would be at least a new swing low that would allow them to get out around break-even at worst. The first bar in figure 11.13 was a bear trend bar and a possible start of a bear trend from the open. The market failed to reverse the bar 2 swing low from yesterday, so it will likely now test yesterday's low at bar 1, an obvious magnet. Place an order to go short at 1 tick below the low of bar 3, even though the big tail at the bottom indicates that the bears are not in complete control. Once the market falls below yesterday's low at bar 1, it should try to reverse up again, so you need to place an order to go long on a stop at 1 tick above the first good signal bar. Bar 4 was a bear trend bar, but the next bar created a down-up twin buy setup, followed by a long entry. If the order wasn't filled and the next bar had a lower low, you would try to buy above its high, since you are looking for a failed breakout below yesterday's low to form an opening reversal up. However, if the market falls much further without a good entry setup, traders should only trade shorts until after a rally breaks a trend line. The market made a small 2-legged rally to the EMA and above the high of the day. The 2 legs were the bull trend bar followed by the bear trend bar, and then the second leg up was the bar 5 bull trend bar. Countertrend moves are often made of 2 legs, and since this might be a bear trend day, this is a good short setup, 2 legs up to a new high, forming basically a double top bear flag at the EMA on a gap down day. Since you were not filled on your short entry order on the bar after bar 5, you would move the stop to one tick below the low of the next bar, a bear inside bar, and you would be filled. This is also a low 2 breakout pullback short. The low one was on the bar after bar 3. Bar 6 is a setup for a high 2 long. The high one occurred after bar 4 and a reversal from a new low of the day and a second test of yesterday's low. This long stalled at the EMA and formed a series of sideways bars and many dojis. Bar 9 was a setup for a M2S short, and it was a decent setup, but it is often best to wait for a clear false breakout when there are sideways bars and dojis barbed wire. Bar 10 was a high 2 breakout to the upside that quickly reversed back down, forming a double top bear flag with bar 9 and trapping bulls who didn't have enough time to realize that they needed to reverse and not just exit. You should never buy a breakout from barbed wire, especially below the EMA. All slow traders were trapped out of shorts by the quickness of the reversal and will be forced to chase the market down. The best trade would be to short once the market formed an outside bar or as it broke below bar 8. The market tried to form a higher low at bar 8, and instead it failed and formed lower highs at bars 9 and 10. The bears are clearly in control, so you need to expect at least 2 legs down. Bar 12 was a breakout pullback that might be the end of the first leg down. In any case, you need to short below bar 12, expecting a second leg down. The bar 12 high exactly tested the bar 6 low, a breakout test, and then the bear resumed. The bar 5 new high converted this day from a trend from the open type of bear, which is very strong, into a likely trending trading range day, which is a less strong bear and often has a late rally that reverses at least the final trading range, making the day close above its low. Third bar of the day, and the 15-minute close. When trading the 5-minute chart, it is easy to not be thinking about the many institutional traders who are also paying attention to 15-minute charts. The first 15-minute bar closes at the close of the third 5-minute bar, and therefore activity around this third bar will influence the appearance of the first 15-minute bar. For example, if the first 2 bars of the day move in one direction and then the third bar is a smaller pause bar, the breakout of the bar will determine if there is a 15-minute breakout or if there could be a failure. And therefore trading the breakout of the third bar of the day often leads to a big move. Do not place a trade on the third bar alone on most days, but be aware of its extra significance. If it is an important bar, there will usually be other price action to support the trade, and that additional information should be the basis for the trade. This is not an important point and can be ignored by most traders. Similar logic can also be used for the last 5-minute bar of the 30 and 60-minute charts, but focusing on such longer time frames and their infrequent entries increases the chances of missing one or more profitable 5-minute trades, and therefore is not worthwhile. Bar 1 in figure 11.14 is the third bar of the day, and it is a small bull reversal bar, and it reversed up from the EMA and a swing low from yesterday. This is a great opening reversal long entry, and it also prevented the first 15-minute bar from being a strong bear trend bar. Bar 3 also reversed a swing low from yesterday and led to a scalper's profit, but the bull entry bar reversed down in an up-down twin reversal for a short entry. Note that bar 3 was a bear trend bar and not a good reversal bar, so this is not a good countertrend long setup. The break below the bar 3 low was also a break below the first 15-minute bar of the day on a day with a large gap down, increasing the odds of a tradable downswing. Strong trend bars in the first hour often predict strength later in the day in the same direction. Sometimes the market trends for the first bar or 2OF the day, and that first bar ends up as one of the extremes of the day. When the market trends from the open, it is important to enter early. This pattern is most common with gap openings, large or small, and although you should always scalp part of your trades in the first hour when you enter a trade where you might be at the start of a huge trend, it is particularly important to swing some contracts. If the pattern is very strong, you should swing most of your contracts and then quickly move your stop to break-even. However, if the strong opening is reversed, a breakout to a new extreme of the day in the opposite direction, then the day might trend in the opposite direction, or it could turn into a trading range, big up, big down day. A strong trend off the open, even if it is reversed, still means that there were traders willing to trade aggressively in that direction, and they will be quick to trade again in that direction later in the day if the reversal falters. If there is a series of strong trend bars off the open, and then a partial pullback that gets tested 5 to 10 bars later, the pullback is followed by a minor retracement, and then a retest of the extreme of the pullback. This forms a double bottom or top flag entry and has a good chance of leading to a new extreme on the day and often leads to a trend. The 7-bar run-up to bar 4 in figure 11.15 had several large bull bars and only 2 small bear bars, showing that the bulls were willing to be aggressive. This is something to remember later in the day if another buy setup appears, making traders more willing to swing part of their longs. Bar 8 was a successful second attempt to reverse the breakout to a new low of the day, so it should be expected to lead to a rally that had at least 2 legs. In fact, the 2-legged rally only had a small pullback, bar 10, making the rally to bar 9 a possible first leg of a larger first leg. It ended at bar 11. Bar 12 was an M2B buy for a second larger leg up, which also had 2 smaller legs. In general, you should not often scalp stocks with average daily ranges under $3, but price action entries still work. You have to trade far more volume, and even a $1 commission eats up too much of a 10-cent scalp. INC had 2 large bear trend bars in the first 15 minutes, and then formed a double top bear flag bars 3 and 5 in figure 11.16. This is a reliable pattern that often leads to a bear trend day. Yesterday's bull was so strong that today's 2-legged selling reversed back up at bar 6, likely at the EMA on the 15 or 60-minute charts, but it was good for at least a 10-cent scalp. Opening patterns and reversals. Besides the gap opening reversals and trends from the open discussed earlier, common reversal patterns and moves on the open are the same as patterns occurring at any other time of the day and include the following trading range breakouts. Sharp pullbacks to the EMA. Failed breakouts of anything, including swing points, trend lines, trend channel lines, trading ranges, and yesterday's extremes. Breakout pullbacks, failed breakouts, that is, a failed breakout that went on to fail. On most days, either the high or low of the day is formed within the first hour or so. Once one of the day's extremes is formed, the market reverses toward what will become the other extreme of the day. Obviously, on a trend from the open day, there is no reversal, but the market still works toward the other extreme, which will usually be near the close of the day. This opening reversal is often recognizable and can be a great trading opportunity for a swing trade. The first move on the open is often fast and covers many points, and it is hard to believe that it could suddenly reverse directions, but this is a common occurrence. The TUM is usually at some key point like a test of the high or low of yesterday, a swing high or low of yesterday or today, a breakout of a trading range of yesterday or today, a trend line or trend channel line, a moving average, or any of the above on a different time frame chart or on the Globex chart. Even if the best setup is on a 60-minute or daily chart, there will almost always be a price action reason to take the trade based entirely on the 5-minute day session chart. So a trader adept at chart reading only needs to watch the one chart that he is using for trading. The patterns in the first hour are the same as those later in the day, but the reversals are often more violent, and the trends tend to last longer. An important key to maximizing trading profits is to swing part of any position that could be a high or low of the day. If the trade looks particularly strong, swing all of the position and take partial profits on a third to a half after the trade has run 2 to 3 times your initial risk. If you had a price action stop that was 3 points, such as the distance to the other side of the signal bar, and a 2-point money stop in the E-mini, your initial risk was 2 points, so take a third to a half off at around 4 points. If there is a strong trendline break, and then the market pauses and appears to be reversing into a trendline breakout test, look to take some more off, maybe a quarter, just in case the entire pattern fails. Hold the remaining contracts until there is a clear and strong opposite signal, or until your break-even stop is hit. Look to add to your position at every with trend setup, like a 2-legged pullback to the EMA in a strong trend. For these additional contracts, scalp most or all of the position, but continue to swing some contracts. Some reversals start quietly and trend only slightly for many bars before forcefully breaking into a trend, whereas others have strong momentum from the entry bar. Be open to all possibilities and make sure to take every signal, especially if it is strong. One of the difficulties is that reversals often are sharp, and a trader might not have enough time to convince herself that a reversal setup could actually lead to a reversal. However, if there is a strong trend bar for the signal bar, the chances of success are good, and you must take the trade. If you feel that you need more time to assess the setup, at least take a half or a quarter position because the trade might suddenly move very far very fast, and you need to be involved, even if only in a small way. Then look to add on at the first pullback. Bar 1 in figure 11.17 is an M2S with a steep EMA, and it closed the gap below yesterday's low by 6 cents, setting up a breakout pullback reversal that formed the high of the day. Bar 2 is an EMA pullback, and then a Roman 2 bull breakout and a failed small trend channel line overshoot reversal. Bar 3 was a failed breakout and reversal up from breaking the trend line from the rally into the prior day's close. Bar 5 was a high 2 double bottom bull flag. The first bottom was 2 bars earlier. That also was the first pullback, a breakout pullback after the breakout above yesterday's high. This could come into a trend from the open trend day. Bar 1 in figure 11.18 for Opal was a second entry low 2 for an opening reversal off a trend channel line overshoot, a failed breakout of the trend channel line. Bar 2 was a reversal down from a breakout, a failed breakout, above the trading range in the final hour of the day before and of the bear trend line going into the close of the prior day. The market then reversed up from the EMA, forming the Bar 3 higher low, which was also a breakout pullback. Bar 4 was a reversal down from a higher high on a day that was not yet a bull, and therefore a good short. It also had a wedge shape and was 2 legs up after yesterday's strong bear. Bar 6 was a lower high after the Bar 5 break of the trend line. Bar 7 was a high 2 breakout pullback in a day with a large gap up, but the market reversed back down at the Bar 8 higher high and failed final flag breakout. Since this was not a bull trend day at this point, this is a good short. Bar 9 was a new low, but it came with strong momentum, making a second leg down likely. Bar 10 was a low 2 and a lower high. Bar 11 was a second entry into the short based on an M2S. It was also a possible spike in trading range top, and then a possible spike in channel bear. Bar 2, in figure 11.19 was a strong bear reversal bar and an EMA test in a strong bear, forming a failed breakout above yesterday's bear trend line not shown. However, it gapped above the trend line from yesterday's bear move and might have a second leg up. The first leg was the gap. Bar 3 was not a reversal bar, but it was a high 2 variant. The high one was the bull trend bar that followed the Bar 2 down bar. That was a breakout pullback, breakout of yesterday's bear trend line. This was a possible higher low after a climactic close, and after a climax, the strong bear into the close had virtually no pullbacks, and since it was likely not sustainable, it was therefore climactic. There is often a 2-legged countertrend move. Bar 6 was a wedge top and a 2-legged move up from the Bar 3 higher low. Bar 10 was a double bottom bull flag and a failed breakout below the 2-legged rally up from Bar 7. The first bottom was Bar 8, or the inside signal bar following Bar 7 low. It was also a reversal up from a test of yesterday's low. Bar 12 was a higher low and led to a breakout in Roman 2 pattern. It was also a failed low 2 in a bear, which trapped bears who saw the big gap down and shorted the second entry low 2 gap pullback, double bottom and double top flags. Unlike a double bottom pullback, that is a reversal pattern, a double bottom bull flag is a continuation pattern that develops after the bull has already begun. Functionally, it is the same as a double bottom pullback, since both are buy setups. The same is true for double top bear flags, which are continuation patterns in an ongoing bear and not a reversal pattern, like the double top pullback. Both, however, are short setups. After a strong down move and a pullback, the bear will resume. If the market pulls back again to about the same level as the first pullback and again finds sellers around the same price, this trading range is a double top bear flag, and it is a short entry setup. The market made 2 attempts to go above a price and failed both times, and this usually results in the market doing the opposite, especially when the opposite is with trend. More often than not, the second pullback will be slightly below the first, as would be expected in a bear trend. Each swing high tends to be below the prior one. The entry is on a stop at 1 tick below the setup bar. Bars 2 and 3 in figure 11.20 formed a double top bear flag on a big gap down day. The gap was the flagpole of the bear flag. Bar 3 give M2's short entry and a minor failed final flag. Bars 3 and 4 in figure 11.21 formed a large double bottom bull flag after the rally to bar 2. Bars 6 and 7 formed a double top bear flag after the strong move down to bar 5. GS pullback had a strong move up to bar 1 in figure 11.22 and then formed a broad double bottom bull flag. Bar 10 slightly undershot bar 6 and formed a double top bear flag. It could have topped out at bar 7 or at bar 5 as well and still have been the same pattern. Bars 8 and 9 formed a sloppy double bottom bull flag, but it had too much of a barbed wire look to be a great setup. Trading range breakouts. Sometimes the market forms a trading range in the first 3 to 10 bars or so with 2 or more reversals. If the range is small compared to the average daily range, a breakout is likely. A trader could enter on a breakout from the range, but the risk is smaller if you are able to fade small bars at the top or bottom of the range, or wait until after the breakout and enter on a failed breakout or a breakout pullback, just as you would with any trading range. Goog went sideways in figure 11.23 into a 700 AM PSD report and then broke out of the trading range to the downside. A trader could enter on a stop below the trading range low, but it is less risky to short the low 2 below bar 5. This is a low 2 because bars 3 and 5 were 2 legs up, bull trend bars separated by 1 or more bear trend bars. It was also a failed high 2. It is basically barbed wire below the EMA and therefore will likely have a downside breakout bear flag. Some days open with a flat EMA, big overlapping bars, and just no safe setups, no small bars near the top or bottom where a fade trade could be placed. This is barbed wire in figure 11.24, and it should be traded like all barbed wire and requires patience. Wait for one side to be trapped with a trend bar breakout, and then look to fade the breakout. Bar 7 was a reversal up after a breakout of the bottom of the barbed wire, but it followed a series of bear trend bars, and there was no prior trendline break and no good signal bar. You need a second entry. Even though it was a high 2, the high 1 was an outside down bar that trapped longs, and that bar should be considered the start of the down move. That is, expect 2 legs after the outside down bull trap bar, making bar 7 actually a high 1, since the down move began at the top of bar 6 and not the top of bar 5. Bar 7 broke a micro trend line across the 3 prior bars but not shown. And then, bar 9 formed a second attempt at reversing the break to a new low below the low of the day and yesterday. Second entries are always good, especially on non-trend days, and this alone was all the reason that trader needed to go long, even with the weak reversal bar a bear close, but at least the close was above the middle of the bar. The market then trended up through the other side of the opening range and gave M2B breakout pullback long at bar 10. First pullback. Entering on the first pullback after a strong first leg is simply capitalizing on the propensity for strong moves to test the extreme. Most strong moves have at least 2 legs, so entering on the first pullback through a trend line has a very good chance of leading to a profitable trade. This entry is especially important on trend from the open days if you missed the original entry. In strong trends, what constitutes the first pullback is not always clear because trends frequently have 2 or 3 sideways bars that don't break a meaningful trend line and therefore really aren't significant enough to constitute a pullback. They are all great with trend entries, and you can continue to enter with trend with confidence even after the first pullback that breaks a meaningful trend line. Only after a trend line is broken has there been a significant pullback, and the first leg has likely ended. Even then, the first break of the trend line has very high odds of setting up a with trend entry that will lead to second trend leg and a new extreme in the trend. Consider the first pullback trade to be the first one after a trend line break, and all the with trend entries before then are simply part of the first leg of the trend. Look for high/low 1 and 2 setups and enter on a stop at 1 tick beyond the setup bar. For a buy on a stop at 1 tick above the setup bar. The market in figure 11.25 formed a bull trend from the open, and the bar 2 break below the micro trend line was the first pullback. Traders should buy on a stop at 1 tick above its high, even though it was a weak signal bar bear close, but at least the close was above the midpoint. The OIH in figure 11.26 had a bull trend from the first bar, and there really never was a first pullback with enough countertrend strength to break a meaningful trend line. The Roman 2 breakout at bar 1 is a good entry, and the bar 3 breakout of the two-legged sideways correction was another. Finally, there was the tight trading range breakout at bar 4. All of these entries should be considered to be part of the first up leg and not a first pullback, which comes after the first leg and sets up the second leg. Rarely, days just don't seem to pull back and traders are forced to enter on breakouts from even brief sideways pauses. The reality is that on strong days like this you can just buy your swing size position at the market at any point, trusting that even if there is a reversal, the odds are overwhelming that the market will make another high before the pullback retraces very far. When that is the case, the odds are very high that your trade will be profitable, because an unclear pullback means the countertrend traders are very weak. Bars 2 and 3 in figure 11.27 were tiny pullbacks that did not break a meaningful trend line. The first pullback to break a trend line was bar 4. The first trend line break has a very good chance of being followed by a second with trend leg, and is a great entry like shorting bar 4. Chapter 12. Detailed day trading examples. Bars 3, 4, and 5 in figure 12.1 were shorts on testing the EMA in a bear. Bar 6 was a second entry bear trend channel line overshoot and reversal up, but the signal bar was weak, a small doji. It was also a wedge reversal. However, the rally from bar 6 broke the trend line, setting up a long on a test of the low. Bar 9 was a lower low test of bar 6 and a bear trend channel overshoot and reversal, and it was a bull reversal bar. Also, it was a failed wedge. The wedge bottom at bar 6 failed, and its upside breakout broke a trend line and then had a two-legged move to a lower low, which is a very strong buy signal, as can be seen by the powerful rally that followed. Bar 10 was an inside bar that ended the first tiny pullback bear trend bar, so traders could go long above it. After the spike and channel bear, bar 2 ended the spike, and the 3 pushes down bars 2, 6, and 9 ended them. It was likely that a protracted two-legged up move would develop, so the bar 10 pause was likely to just be part of the first leg up and not the end of the first leg. That would make the leg too small for what should be expected based on the size of the pattern that created the reversal. Spike and channels usually retrace to the start of the channel, which was the bar 3 high. Bar 11 was an M2B buy setup. The high one was 2 bars earlier, and the actual first pullback since it broke a trend line. The 5-minute Eurust forks in figure 12.2 reversed down at bar 2 after a new high. This bull leg had strong momentum, as evidenced by 8 bars in a row without a bear trend bar, so the odds were high that there would be a higher low rally that tested the bar 2 high before there was a breakout below the start of the leg, bar 1. Bar 3 was an EMA gap bar that also was a breakout test of the bar 1 beginning of the rally. The market formed a triangle, which ended up as a tight trading range. Bar 8 was a failed upside breakout attempt, 1 tick below the bar 4 high that reversed through the bottom of the range in a bear outside bar. It formed a double top bear flag with bar 6. Bar 9 was a breakout pullback small bar above the middle of the outside bar, offering a low-risk short. Bar 10 was another breakout pullback short. You would not be buying above that small doji because a doji is a 1-bar trading range, and you don't buy above a trading range in a falling market. Bar 11 was a M2S short and a second attempt to break out below the bar 3 spike low. Bar 12 was another M2S. Always keep placing your orders. A bear might become complacent because of the bull doji high or low, but you still need to be thinking that the market is in a bear swing, and if it falls below this bar, it will form an M2S. Bar 13 was a Roman 2 long setup with a strong bull bar for the second bar after the trend channel line overshoot. Bar 15 was 3 pushes up and the first EMA gap bar. Bar 16 was in Roman 2 setup with bull Roman 2 bars for a higher low long, since traders were expecting at least 2 legs up from the trend channel overshoot and reversal off the bar 13 low entry. Formed a double bottom bull flag with bar 14. The large bear trend bar trapped bears into shorts and trapped weak bulls out of longs. Bar 2, in figure 12.3, was a trading range after the bar 1 spike up. Bar 3 was a second small leg up after the bar 1 spiked down, and it broke out of the top but failed a failed final flag, setting up a nice short below bar 3 or below the trading range. Bar 4 overshot a bear microtrend channel line and reversed up. The entry was above the bar 6 Roman 2 bar, which had a bull close. Bar 9 was a wedge and a four-legged move up from the bar for low, making it a low for variation. It was a test of the bar 3 high but could not get up there to form a perfect double top bear flag. Bar 10 was a breakout pullback from the trendline breakout. Bar 11 was a huge bull reversal bar following a new low on the day, but bar 12 could not trade above it, making a short below bar 12 inside bear trend bar a great entry because of the trapped longs who entered early in bar 11. It was also a breakout pullback, as was the bar 13 short. Bar 1 in figure 12.4 was a high 1 breakout pullback from the breakout of the earlier trading range. Bar 3 was a good high 2 long, despite the barbed wire, because bar 2 was not a climax and the momentum remained strong, as seen by the large bull trend bars leading up to bar 2. Bar 5 was a 3 push high short, so 2 down legs should follow. A climax usually is followed by at least 2 counter-trend legs. The move down to bar 6 broke the trend line, and it broke below the bar 3 higher low of the bull, indicating strong bears. Bar 7 was a 2-legged breakout test of the bar 5 signal bar, and it was a lower high and an up-down twin short setup and a sharp rejection of the poke above the EMA. Chart below is a close-up of this area. It is virtually impossible for most traders to read a chart correctly fast enough to catch most of these trades in figure 12.5, but the chart illustrates that price action analysis even works on the 1-minute level. Bar 1 in figure 12.6 was a failed low 2, so effectively a high 2 long. Bar 2 was a wedge short and a failed breakout of a bull flag. Bar 3 was a breakout pullback short. Bar 4 was a breakout test short even though it was a higher high above the bar 3 swing high, which is a sign of strength. Bar 5 was a lower high and an M2S below the EMA. Bar 6 was a wedge long and an expanding triangle bottom. Bar 7 was a failed trendline breakout short. Bar 8 was a 2-legged lower low after the bar 7 break of a trendline and a lower low on a trading range day. Bar 10 was a wedge and a lower low on a trading range day. Bar 11 was the first pullback after a trendline break, and it was an M2B long. Bar 12 was another bull M2B. Bar 13 was a wedge short and a possible double top bear flag with bar 4. Bar 14 was a failed trendline and trading range breakout failure, a double bottom bull flag, and a possible start of a second leg up. Bar 15 was a high 2 that followed a breakout test 2 bars earlier. Bar 16 was a high 2 and a bull. Bar 17 was a wedge and a failed test of the high of the day, and therefore a possible lower high. Bar 19 was a bear low 2 M2S and a 5-tick failure for traders who bought bar 18. Bar 20 was 2 pushes to a new low of the day. Bar 18 was the first in a trading range day, even though there was a strong bear leg from the bar 17 high. It is not a bear day at this point. It was also a reversal up after a 1-tick new low of the day, a 1-tick failed breakout. It was also a wedge. Bar 21 was a small second leg up and a possible double top bear flag with bar 19. Bar 22 was a 2-legged pullback to a higher low after a trendline break, bars 17 to 19, and a double bottom, bars 10 and 20, pullback long. Bar 23 was a failed trendline break and a double bottom. Bar 23 was 1 tick higher than bar 22, bull flag. Chapter 13, Daily, Weekly, and Monthly Charts. Although daily, weekly, and monthly charts can generate intraday signals, they occur so infrequently that they become a distraction for a day trader and should be ignored. The most common signals are those based on yesterday's high and low, and you can see them on a 5-minute chart. However, there are frequently price action entries on these longer time frames, but because the signal bars are so large, far fewer contracts can be traded if the risk is to be the same as for a day trade. Also, overnight risk may mean that you should reduce your contracts even further or consider trading option strategies that have a defined risk, like outright purchases or spreads. Day trader should only trade these charts if they do not occupy his thoughts during the trading day, because it is easy to miss a few day trades using large volume while nursing a trade of far fewer contracts or shares based on the daily chart. and these misses can more than offset any gain from the daily signal. The price action of the stock of the largest companies in the world usually behaves in a more predictable way than that for the stock of small companies. The risk of a huge, overnight adverse move, especially on the upside in a protracted bull, is much less. This means that a countertrend trade in WMT has a smaller chance of failing than in CHK. However, the profit potential is also less. When trading counter to a strong trend, the goal should be a scalp of 1 or 2%, since most countertrend trades just result in pullbacks that become with trend entries. Gaps complicate the entries, and in general, the risk is less if the market opens within yesterday's range and then trades through the entry stop at one tick beyond the range. If you cannot watch the stock intraday and there is a gap open, it is probably best to pass on the trade. If you can watch the stock and there is a gap opening, watch for a gap pullback, and then enter on the failed pullback into the gap, as the market resumes its move away from yesterday's range. In other words, if you were looking to buy but today gapped up, look for a sell-off on the open today and then buy a breakout pullback reversal back up, placing your stop below the low of today. If the entry fails and your stop is hit, look elsewhere or give it only one more try if there is a second buy setup. Don't spend too much time on a stock that is not doing what you wanted it to do because you will lose money. There is a natural tendency to want to make back your money on the same stock after a loss, but this is a sign of your emotional weakness. If you feel a need to prove that you were right and are in fact a great chart reader, you might be right about that, but you are not a great trader. Great traders accept their losses and move on. Pullbacks on daily charts rarely have classic reversal bars, leaving traders with more uncertainty than when trading 5-minute charts. Uncertainty means risk, and when there is more risk, position sizes need to be smaller, and a trader will have to consider taking a partial position and adding to the position as the price action unfolds. In a bull pullback, additions can be made at a lower price if the market sells off a little more, but the bears have not yet demonstrated that they are in control. Additions can also be made at a higher price after the trend has resumed and a small pullback forms a higher low above your original entry. When you scan your daily charts at the end of the day, you will frequently see setups to consider for the next day. Once the setup triggers, there will often be an intraday trend that will provide you with many good 5-minute with trend entries. If the stock is not one that you normally trade intraday, but its volume is about 5 million shares or more, it is worth considering adding it to your basket of day trading stocks for a day or two. Sometimes, however, even with very liquid stocks such as the OIH, your broker might not have an inventory available for selling short, and you might be only able to trade by setups. Price action is the cumulative result of a large number of traders acting independently for countless reasons to make as much money as they can. Because of that, its fingerprint has remained unchanged and will always provide a reliable tool for making money for those who can read it. Figure 13.1 is a daily chart of the Dow Industrials in 1933 and 1934, and it looks like any stock trading today on any time frame. Bar 2 is a low 2 that broke a trend line. Bar 3 is a small failed final flag reversal and a lower low test of the bar 1 low after a trendline break. A trendline break followed by a test of the trend's extreme can be a major trend reversal. Bar 4 is a breakout pullback and a small higher low. Bar 5 is the first pullback in a strong bull and a high 2. Bar 6 is a wedge that led to 2 large legs down, ending at bar 8. A wedge at the end of a strong surge usually results in a very deep pullback and then a new high. Bar 7 was a trendline break and a 2-legged pullback. Bar 8 was a lower low after a trendline break and a breakout test of bar 2. Bar 10 is a higher low. Bar 11 is a high 2 breakout pullback after the breakout above the failed bars 7 and 9 double top bear flag. Bars 12 and 13 are reversals up after a minor trendline breaks. Bar 14 is a wedge. Bar 15 is a trendline break and a strong momentum countertrend move that will likely be tested after a rally tests the bar 14 high. Bar 16 is a wedge, and bar 17 is a failed breakout of the wedge. Bar 18 is the lower high test of the bar 14 bull trend extreme, and it is a low 2 entry for a short on the wedge failed failure. There was a failed breakout below the wedge, and now the wedge is failing on its upside breakout. A failed wedge often leads to a strong reversal. Bar 18 is also a breakout test of the bar 14 signal bar low. Bar 19 is the test of the bar 15 low and is a double bottom bull flag. Bar 20 is a higher low pullback in the reversal up and a double bottom pullback. Apple was in a strong bull on the daily chart thumbnail and had a first EMA pullback at bar 1 in figure 13.2, which was a bear trend channel overshoot. The numbering is the same on both charts. Bar 2 on the daily had a strong intraday reversal up and closed near its high. It was reasonable to want to buy at one tick above the high of day 2. However, the next day gapped above the day 2 high. Rather than risk a possible reversal down day, it would be prudent to watch for a reversal up after a pullback test of the gap. Bar 6 on the 5-minute chart closed the gap and was an EMA gap bar and a bear trend channel overshoot and reversal up. This was a great long entry with a protective stop below bar 6. This 62-cent risk led to a several dollar gain. After an extended bull run, the market broke out of a bull flag after the high 2 pullback at bar 2 in figure 13.3. Bar 7 was a test of the trend channel line drawn across the highs of bars 3 and 5, and it was also the signal bar of an expanding triangle, which set up a great short for at least a 2-leg pullback. Whenever a trade could be a major reversal, it is imperative to swing part with a break-even stop after scalping out of some of the position. Bar 11 broke above the bear trend line, but after this strong a down move, the bulls would be reluctant to buy, expecting a second leg down from any rally. The market poked above the trend channel drawn from the highs of bars 10 and 12 and formed 2 dojis at bar 13, meaning the bulls were no longer in control of the rally from bar 11. This is a possible setup bar for an EMA gap 2 bar down, second attempt to close the gap to the EMA, so you must place an order to go short at 1 cent below the low of bar 13. Since there are so many gap opens in stocks, resulting in terrible fills, it is better to place the order only after the open and only if there is no gap. If there is a gap down, as there was here, you would use the 5-minute chart to look for a price action justification for a short after the rally closed the gap. Bar 14 broke above a micro trend line. You would place an order to short at 1 cent below the low of bar 14. This is a variant of a breakout pullback, even though the breakout below the low of bar 11 has not yet occurred. 4 bars down to test the low of bar 11 were very vertical, and you would expect it to behave the same as if in fact there was a small breakout. Therefore, the short below bar 14 is a type of breakout pullback entry, and these trades often lead to protracted moves. The entry bar had a shaved top, which means that the bears were in control from the first minute. Bar 11 ended the first leg down, and bar 16 completed the second leg of the 2 legs down. Since the move down to bar 16 was so steep, it is better to wait for a test of the low before going long, or some other indication that the sellers were going to wait for more price action before they short again. However, the steepness of the second leg and the size of the bear trend bars imply that there is a high probability of this being a sell climax, which usually is followed by at least a 2-legged countertrend rally that lasts for far more bars than most would expect. The 2-bar rally off the low broke a trend line, albeit a steep one, so it is sensible to buy the bar 17 high 2 higher low. You could then short the low 2 near the EMA at bar 18, or wait for more price action, since the pullback did not reach the EMA, and it is a bull trend bar, so more rally is possible. Bar 19 was a signal bar for a low 2 and a bear and a failed high 2, near the EMA, so it is a strong short. It was also a 3-bar long double-top bear flag. Bar 20 poked below the bar 17 low, but immediately found buyers and the shorts covered. The market tried to form a double-bottom bull flag. The longs from the bar 20 signal bar only made it to the EMA, where they would take partial profits and move their stops to break-even. It would have been stopped out, but they would buy again at the high 2 off the bar 22 signal bar that tested the bar 16 bear low, and it followed the bar 21 break of the bear trend line. There was not a strong reversal bar, and although this could be the start of an extended bull and it must be bought, you would have to expect more 2-sided trading to unfold before a strong trend in either direction begins. GE rallied sharply in early 1987, but there was a small short based on the bar 6 signal bar that was a reversal from a second overshoot of a bull trend channel line drawn from bars 2 and 3 in figure 13.4. The fill was 1 tick, 1 cent below on a stop. Since there was not yet an earlier downward surge, this is likely going to fail on a two-legged down move to around the EMA and be followed by a new high. The M2B high 2 near the EMA at bar 9 was a good long entry for a test of the highs. Bar 11 broke through the trend channel line attached to the high of bar 5, which is a parallel of the trend line drawn from bars 1 and 8. You would get a similar signal by drawing the trend channel line across the highs of bars 2 and 5. Bar 11 was a potential signal bar, but the next bar failed to take out its low. Instead, the next bar was an inside bar reinforced by a strong bear close. If you placed an order to short at 1 tick below its low, the order would be filled on the next bar, turning that bear inside bar into a signal bar for this short. After such a climactic move up through the trend channel line, and following the earlier trend line break down to bar 8, the shorts should expect at least 2 legs down to test the bar 8 start of the channel up after the bars 1 to 6 spike. Bar 13 was the second small leg up in the pullback from the potential new bear. It is 2 legs up because there was a bull trend bar off the EMA, and then a bear trend bar a down leg on a smaller time frame, and finally a second leg up, made of consecutive bull trend bars. Since the shorts are expecting a second leg down before any possible new high, place a stop order to go short at 1 cent below bar 13, which becomes the signal bar once the order is filled. The initial stop goes above the high of the signal bar. Once the entry bar closes, lower the stop to 1 cent above its high. The market crashed in a large second leg down to bar 14. Because this is 2 legs down and it did not take out the low of the prior bull, it could form a higher low in a longer time frame bull. Also, since the bear trend bars were so large, it is likely that there will be at least 2 legs up and likely 4 legs. And the sideways to up action should last for a long time, at least 20 or 30 bars, as an approximation based on eyeballing the chart. The bears will likely relinquish control for an extended period and wait for more price action before being willing to short aggressively. They will, however, short every rally and take profits at every pause in the down move. Likewise, the bulls know that the market will probably go sideways to up for a long time, and they will start buying the dips but exiting quickly on stalled rallies until there is price action that indicates that a trend up or down has begun. R16 is a potential signal bar for a low 2, so the bears will place an order to short at 1 cent below its low. Bar 17 tested the bear low and is a potential high 2 signal, so the bulls will place buy orders at 1 tick above its high, and the shorts will exit the remainder of their positions. It is a failed final flag. Bar 18 is a double top bear flag with bar 15. Bar 20 is a short entry bar based on a low 2, especially after the market failed to hold above the micro trend line, not shown over the 6 bars down from bar 18. However, this is barbed wire, and it is usually better and always less stressful to wait for a breakout to fail and then enter on the failure. Bar 21 was another test of the bear low, forming a double bottom with bar 14, or with bars 14 and 17 both being considered as the first bottom. Rally to bar 18 also broke a steep bear trend line from bar 13 to any of the bars around bars 15 and 16. A broken trend line, and then a possible double bottom, could be the start of a new bull trend. Bar 21 also reversed a break below a 7-bar bear trend channel line, drawn using a best fit of the bottom of the bodies of those immediately prior 7 candles. Rally to bar 22 broke another bear trend line. Breaks of multiple bear trend lines is a strong indication that the bulls are asserting themselves and that a protracted swing up is becoming more likely. However, this was also the first test above the EMA, so the low 2 after bar 22 is a good short, expecting 2 small legs down. Bar 23 setup, a high 2 long entry that was also a higher low above bar 21, and a double bottom pullback, and it followed a rally up to bar 22 that contained 7 consecutive, albeit small, bull candles. The 9-bar rally up to bar 24 contained only 1 bear candle, and was followed by 5 consecutive bull bars that closed above the EMA, both indicating that the bulls are owing the market. R26 reversed after poking above a bull trend channel line, a parallel from the bar 23 and 25 lows. and the bar 15 initial up move off the climactic low. This is a potential double top bear flag. Since there was so much strength on the rally to bar 26, it is likely that its high will be tested before the bar 23 low is taken out, which would negate the expected 2 legs minimum down. Bar 28 set up an M2B a high 2 at the EMA. Also, it was second of 2 bear trend bars that tried to push back below the EMA. The first occurred 3 bars earlier, after 24 consecutive closes above the EMA. When 2 attempts at something fail, expect a big move in the opposite direction. It is also a breakout pullback from the bar 26 rally above the trading range that has been in effect since bar 15, and a large double bottom pullback from the bars 14 or 17 and 23 or 21 double bottom, and is sometimes called a cup and handle long setup. Bar 29 tested the bar 27 high, creating a breakout test, and then violently surged up in a large outside bar up, trapping weak longs out of their positions and forcing them to chase the market up. Bar 31 tested the gap that followed bar 30, and it also set up a high 2 bull pullback long. There was a 2-legged move down from the 2000 high, with the first leg ending at bar B in figure 13.5. The rally to bar C broke the trend line, so traders were looking to buy a higher low or lower low test of the low of bar B. R1 dropped too far below bar B for traders to aggressively buy there in the absence of more price action. Bar 5 was in barbed wire, 3 or more overlapping bars with 1 or more being a doji, so you should only look to short a small bar near the high or buy a small bar near the low. Although bars 1 and 5 did not have identical lows, they were close enough to be a possible double bottom, and in trading close is usually close enough. The rally from bar 5 broke a bear trend line, so traders will look to buy a test of the bar 5 low. Bar 11 reversed up from a deep test of the double bottom low. This double bottom pullback completed the 2 legs down from bar, and an extended bull ensued. As is typical, the bull took out the highs of the bull signal bars that formed in the bear down from bar to bar 5. Bars 1, 5, and 11 correspond to those in the daily chart below. The rally up to bar 15 was very strong. It is interesting to note that any pullback would be expected to test the bear signal bars in the rally up from the bar 11 low, see next chart. The sell-off in fact fell through all of the earlier bear signals and became a major bear. However, nothing is ever surprising, and traders should just trade whatever patterns appear on the chart that they use for trading and not necessarily trade monthly patterns. The bar 15 top was a 3 push-up higher high test of bar A. There obviously was a trend line break in the bear down from bar A. Also, the 3rd push-up to bar 15 followed a small trendline break. Bar 16 was a M2S after the break of the major bull trendline. Bar 17 was a low 1 breakout pullback. Although bar 18 is a huge bar that might turn out to be a climactic test of the bar 5 low, there is absolutely no price action evidence of a bottom at this point, despite what the pundits are saying on television. Climax might lead to a reversal or a trading range, but there has yet to be a break of the bear trend line, and there has been no significant upward momentum. The trend is still down, and although it is hard to imagine that the market could get much lower, it can. The market is not trading based on valuation at this point, and when it is emotional like this, it will keep dropping until the last seller has sold. When he does, there will be a rally that will break a significant bear trend line and then a test of the low, but until then, the trend is still down. Incidentally, although pundits have been attributing this 2008 crash to the housing bubble and the related banking crisis, the housing market began its crash almost 3 years earlier. The credit crisis has been simmering for at least a couple of years. What did happen was the world realized that Obama was going to become president and that he would increase business regulations and increase the cost of labor, both of which would reduce corporate profitability. When companies earn less, their stock is worth less. The worldwide market was just rapidly adjusting the value of stocks to reflect the reduced earnings that smart money anticipates under Obama. It is likely that the market has discounted this too much, and that the market will rally back over the next many months as it waits to see what Obama does. This is similar to the huge stock market rally that began when the Republicans took over Congress in 1994, and it was never attributed to them, by the way. I am a very liberal independent and not a Republican. The world adjusted its earnings expectations dramatically upward, significantly increasing the value of stocks. None of this is useful to a day trader, but it is an example of being willing to think differently from the experts and being comfortable holding a minority opinion. Never be afraid to see things differently from everyone else, especially the experts on television. The strong rally up to bar 3 in figure 13.6 broke well above the EMA and broke the trend line. The end of the rally had a wedge look to it, and whenever there is a wedge at the end of a strong surge, there is often a test of the start of the move, the bar 1 low. Bar 5 was a lower low test of bar 1, forming a double bottom. Remember, traders live in a world of imperfection, and if something looks reasonably similar to a reliable pattern, it will tend to act the same way. There was a bear trend channel break and reversal at the low, which was at the end of the big move down from bar 3, and a test of bar 3 is possible. Bar 7 was a lower high test of bar 3, forming a double top bear flag, and it also ended in a small wedge and therefore likely would have a deep retracement. Bar 11 was a deep test of the bar 5 low, and it reversed up, forming a double bottom, bars 1 and 5 pullback, and then an extended rally. Bar 11 also was a failed break below a bear trend channel line, setting up for a test of the bar 7 start of the leg down. However, the double bottom pullback on the daily, weekly, and monthly charts made the test of bar 7 tum into a breakout instead of a failed test followed by another sell-off. Many technicians would refer to this as a head and shoulders bottom, but that does not tell anything about the price action. Most double bottom pullbacks are head and shoulders bottoms, but since most head and shoulder patterns fail, they usually just become continuation patterns instead of reversal patterns. And most double bottom pullbacks succeed, you should distinguish them and never bother with the term head and shoulders. Bar 1 in figure 13.7 was a spike, and it led to a channel that ended at bar 6. The bars 2 to 3 rally was another spike, and it also led to a channel that also ended at bar 6. The market has been so strong that it never attempted to retrace to the beginning of either channel, bars 2 and 4. The bars 2 to 6 rally also was a spike that led to a channel ending at bar 9. Again, there was so much strength that the bar 10 pullback did not come close to the bar 7 start of the channel. There was a thin area between bars 1 and 4 on the breakout, and then a trading range that ended around bar 4. This was followed by close to a measured move up to the top of bar 6, from bar 2 to the middle of the bar 4 trading range. There was another breakout thin area between bars 5 and 7, followed by an approximate move from bars 4 and 5 to around bar 9. The middle of the bar 7 trading range was the pause after the spike, and it gave a measured move from the low of the chart to the top of the chart. There was a breakout pullback long shortly after the breakout from this flag. Remember, however, that measured moves are just observations, and you should not consider them while trading. The channel attempted to fail on the bar 10 sell-off, but instead formed a double bottom of gap bars below the EMA. There were several other failed trendline breaks all of the way to the bar 16 high that were also good long setups. Thin area between bars 9 and 12 projected to around the bar 13 high from the bar 7 low. The bar 15 plunge below the EMA, and the major trend line was almost certainly going to be tested after a test of the high. The high test was an overshoot, higher high that was a wedge pattern, a spike up, and then 3 small pushes up to bar 16, and the end of an expanding triangle bars 11, 12, 13, 15, and 16. Bar 18 was a breakout pullback, a variant, since the breakout below bar 15 did not yet happen, but the momentum down to bar 17 was enough to make the chart act like a breakout, and a double top pullback. Bar 20 was another breakout pullback and a test of the bars 7 and 10 trendline from below. After the market sells off to test the bar 19 low, it will attempt to form a double bottom pullback. But with the strength of the selling down to bar 19, the market more likely will form a second leg down that ends below bar 19, and it might ultimately test the bar 7 channel low or even continue much lower. Whenever the market has so much strength that it does not come back to test the expected prices for several patterns, as it did here with the spike and channel bottoms that go all the way back to the bar 1 spike. When the correction finally comes, it will usually last longer and be much deeper than anyone anticipates. Corrections after channels usually lead to trading ranges, and since this is a weekly chart, we may go largely sideways for several more years. Ultimately, the market will break out in one direction or another. And since we are in a growing economy and the E-mini is an average of the value of that economy, the market ultimately should break out of the upside, but that could take a long, long time. All of the pundits on CNBC have been saying that the bottom is in and that we are on the way to new highs, but the price action appears to be saying otherwise. However, anytime the market is up a couple of percent, they round up bulls proclaiming evidence of the next great bull, and every time it drops a couple of percent, they find the bears who claim that we are heading to a depression. You should look at them with amusement because you don't trade in their time frame, and the predictions have nothing to do with your income, and nothing to do with what the price action is telling you. These observations demonstrate that the same ideas that work for day trading also work for longer time frames. Huge volume reversals. When a stock is in a steep bear on the daily chart and then has a day with volume that is 5 to 10 times normal, the bulls may have capitulated and a tradable bottom may be present. A huge volume day is very often a gap down day, and if it has a strong bull close, the odds of a profitable long increase. Traders are not necessarily looking for a bull reversal, but after a climactic sell-off, the odds are good that there will be at least a two-legged move to at least the EMA that will allow them to place a profitable trade that will last from days to weeks. Incidentally, on a 1-minute E-mini chart that is in a strong bear, if there is a huge volume bar about 25,000 contracts, it is unlikely to be the end of the bear, but often is a sign that a pullback will come soon, usually after 1 or 2 lower lows on less volume divergence. You should rarely, if ever, look at volume on intraday charts because of its unreliable predictive value on the 5-minute chart, which is the chart that you should be using exclusively for trading. Lehman Brothers opened with a huge gap down on bar 3 and then ran below a bear trend channel line from bars 1 and 2 in figure 13.8, but rallied strongly into the close. Volume was 3 times that of the prior day and about 10 times that of the average of the past month. With such a strong bull trend bar seen more clearly on the candle chart thumbnail, it was safe to buy at the close, but a more cautious trader would wait until the market took out the high of this possible signal bar. The market gapped up on the next day. A trader could either buy the open, wait for a test down and then buy a new intraday high, or look for a sell-off on the 5-minute chart and buy the reversal up after the attempt to close the gap failed. This kind of strength is almost always followed by at least 2 legs up. The second leg up to bar 6 occurred after the successful bar 5 gap test higher low and a penetration of the EMA. Bars 4 and 6 formed a double top bear flag. Bar 7 attempted to form a double bottom bull flag with bar 5, but instead it resulted in a breakout pullback short entry 3 bars later. As of today, the market is currently testing the bar 3 low, attempting to defend the stops below it and form a double bottom. But if it fails, there will likely be panic selling below the bar 3 low that everyone was seeing as a strong, high-volume bottom. Bear Stearns in figure 13.9 had a huge bear trend day on a Friday with volume that was about 15 times that of a typical day, and the stock lost about 70% of its value over the prior 2 weeks. However, the volume was only about 1.5 times that of the day before, and there was only a minimal bull tail. Price action was against the longs since there was no reversal from the break of the bear trend channel. In fact, the huge bear trend bar closed well below the line, confirming the strength of the trend channel line failure to contain the bear. The stock lost another 80% when it opened on Monday, bar 3, but traded slightly less volume. Traders who bought the Friday close, thinking that a climactic bottom was in and that there was no way that the country's 5th largest investment bank could fall any further, were devastated come Monday. Climactic volume in the absence of bullish price action is no reason to fade a strong bear trend. A television pundit might recommend the purchase, but without supporting price action, it was simply too risky. This chart is during the same time as the above LEH chart. However, the LEH chart did not break the bear trend channel line bar 3 until Monday, and it reversed up on that day on huge volume. Here on the BSC chart, the huge volume day was a day earlier, and it also broke below the bear trend channel line, but the day closed near its low with no bullish price action. It gapped down on bar 3, just like LEH. Bar 3 is the Monday for both stocks. but LEH rallied strongly whereas BSC could barely rally at all. Bar 3 for BSC was still a bull reversal bar following the break of a bear trend channel line. But any trader choosing between buying LEH and BSC on that day would obviously much rather buy LEH because of its very strong bull reversal bar. Even if a trader bought BSC at one tick above bar 3, he would have made more than 100% over the next 3 days, but LEH was clearly a much more certain bull bet. Since this chart was printed, BSC was bought out by JPM for a tiny fraction of its market capitalization of just a few months earlier. Within several months, LEH also went under. Chapter 14, Options. A day trader will make more money if he does not trade off the daily charts because it is likely that his overall profit will be reduced by being unable to give his full attention to his day trades. Yes, it is fun to make money on options, but you will likely pay for that fun with income that you failed to make off day trades because you were distracted. There will be a couple of times a month when you might see a great opportunity for an options purchase. But if you are a day trader who is trading options more often than that, you are probably foregoing too much money on missed day trades to make it worthwhile. Although there are many ways to trade options based on price action, if you are primarily a day trader, you want to limit your thoughts to the 5-minute E-mini chart during the day. However, you can use options sparingly when fading big moves on the daily chart. It is easiest to mostly buy puts or calls, and sometimes sell spreads and look to hold the trades for 1 to several days. You can allow one new extreme against your position, and you can be willing to add on because your risk is exactly known and limited with these strategies. At a possible top, you could also simply sell short a small stock position, but you might tend to watch it too much during the day, and this would cause you to miss day trades in the E-minis and ultimately negate any gains from the stock trade. There is one other rare occasion in which intraday options can be preferable to futures and stocks. That is when the market is in a huge freefall and it is close to limit down. If a reliable reversal pattern sets up, you might think that the risk of buying is small, even if a small position, but it can be substantial even with a reputable broker. How can that be? Because their system can get overloaded and your orders might not get processed for 30 minutes or more. If you just bought what you thought was a bottom and then the market fell through your protective stop, your order might not get reported as filled for 30 minutes and you don't know when it will get filled. You could easily lose 10 points in the E-mini. An alternative is to buy calls, so that you will be certain of your risk. Chesapeake Energy in figure 14.1 rallied 85% in the past 4 months, but developed many small pullbacks after the sharp sell-off in March, increasing the odds of a reversal from a new high. The market broke above the trend channel line drawn across bars 1 and 3, and the line drawn across bars 3 and 5. The final 6 days of the bull formed a wedge when looking at a trend line drawn from bar 6 and using just the bottoms of the bodies. There was a strong move up from bar 4 followed by 2 more runs to new highs. Bar 8 was a small bar with a bear close. All of these are signs that the bulls were losing control of the market, and there was now a very high likelihood of a pullback to the 20-day EMA, as at bars 2 and 4. And a reasonable chance of a test of the trend line drawn using bars 2 and 4, and possibly a major trend reversal. The ideal fade was to buy puts during the day of bar 8 or wait until the next day when the market traded below the low of bar 8, forming a low 2, which is a second chance short entry at a new high, a very high probability trade. You would buy at the money puts in the front month because they would have the least slippage, most liquid, and not worry about time decay since a fast move was likely. An alternative trade would be to sell in at the money call and buy the call 1 strike higher, but this is too complicated, and the down move should be sharp so long puts offered the best risk-reward ratio. There has yet to be an EMA gap bar pullback, and this sell-off is likely to produce one. It would then set up a rally to test the bar 8 high. Apple in figure 14.2 rallied over 300% in less than 2 years, and then sold off 55% over 2 months down to bar 6 on this weekly chart. Buying puts at the low 2 at bar 5 was a good trade since there was first a strong move down to bar 3 that broke below a bull trend line from bar 1. Also, this low 2 entry bar was a second break of the bull trend line drawn from bar 3, and a 2-legged higher high 2 legs often end a move. Both the sell-offs to bars 1 and 3 tested the 20-week EMA, and the odds were high for at least that much of a correction off the high at bar 5, since the bears had already demonstrated good strength twice before in this bull. Bar 7 was an EMA gap 2 bar, a second attempt to rally to close the gap below the 20-week EMA. It is also a double bottom bull flag with bar L. A minimum target is a rapid test of the moving average. Instead, the rally was so strong that more retracement up was likely, as was a second leg up. Since the move down from the high at bar 5 was so strong, the odds are high that there will be at least an attempt to test the lows of bar 6 before Opal exceeds the bar 5 high. A large trading range is forming, but the top might be in. Once there is a signal bar, a put purchase would be a reasonable trade. When the moves are this violent, the market is less predictable, and risk is greater. A good way to have a defined risk is to buy options. ANR in figure 14.3 was in a strong bull on the daily chart insert and broke out of the top of a wedge 4 days ago. Yesterday, it gapped above another trend channel line and above 100, a psychologically important number and therefore a magnet. As soon as the 5-minute chart started to come down, a test of 100 was likely. The July 100 puts could have been bought for 7.20, and a reasonable protective exit would be a trade above the top of the trading range at the open, risking maybe $1 or so on the puts. At bar 2, those puts were 8.80. This first pause was a great place to take partial profits because there could be an opening reversal back up after testing below the EMA and below 100. However, the move down off the open was so strong that there would likely be at least 2 legs down. If a trader moved his stop to around 7.30, it would never have been hit, and the puts were worth over 10.00 by the close. On the daily chart, the day turned into an outside-down day. In strong bulls, there is usually not much follow-through on the next day here. There was a small doji day, because the large outside-down bar will likely be the start of a small trading range. However, a test of the rising daily EMA is likely in the near term. When a day trader makes windfall profits off options, it is best to close the position and then look for other opportunities tomorrow. There was likely little left to be gained from this position, and holding it into the next day would be a distraction from day trading. In figure 14.4, when today gapped below yesterday's low and below a trend channel line and reversed up in an opening reversal, a trader could buy July 170 calls for 5.70, and the market's volume was so good that you could buy 50 at that price, and the bid-ask spread was a dime, fairly tight. That is an advantage of trading stocks with large volumes. You could have sold half at the bar 5 test of the bar 3 high for 9.20 on a limit order. You could have sold the balance on the bar 6 double top and lower high for the same price. That is a profit of $150 per call, less commissions. The initial purchase price of 5.70 was $570 per call. Since this is a great entry, you could risk about $200 per call price of 3.70 and double up on a $100 drawdown if there was a second long entry. This was not necessary since the first entry worked well. The bar a low of the day also indicates today's bar on the daily chart on the left. Chapter 15, Best Trades. All of the trades in this chapter have already been discussed, and additional examples are included here for review. One or more of these setups occurs every day on the 5-minute E-mini chart and on the 5-minute chart of just about every market. If a trader had the patience to wait possibly hours for one to develop, and he restricted himself to only the trades in this chapter, he would be a very successful trader. However, learning to restrict yourself to the very best trades is perhaps the most difficult part of trading. If you are not making money yet, it is something that you seriously need to consider trying. One important component to making money is avoiding bad trades that invariably erase much more than what you will have earned from your good trades. The single most important trade to avoid until you are a skilled, profitable trader is barbed wire, especially when it is in the middle of the day's range, near the EMA and on the wrong side of the EMA, and the day is not a clear and strong trend day. Let's start by going back to the very first chart in the book, where there were a number of excellent entries on the daily chart of Opal, all of which belong in this chapter. This chapter shows trend lines to make some of the trades easier to see and understand. Bar 1 in figure 15.1 was a two-legged pullback flag triangle tight trading range to the EMA with a high 2-buy signal. It was the first pullback after breaking a steep trend line. R2 was a wedge short and also a small expanding triangle. It followed the bar 1 break of a trend line and so was an acceptable countertrend entry, and after a wedge, it should have 2 legs down, and it did. Bar 3. The number is well above the bar, was an M2S and a double top bear flag after a sharp down move from a wedge, so a second leg down was likely, and a double bottom bull flag with bar 1. R4 was a wedge and a gap too long that reversed up after testing below the bar 1 flag. Bar 5 was a high too long breakout test of the breakout above bar 2. Bar 6 was a wedge short after the large trendline break at bar 4. It normally would go through the EMA and likely have 2 legs. However, the down move was climactic, and it covered a reasonable distance down but did so in just 1 leg. Bar 7 was a gap too long and a double bottom bull flag with bar 5 and a second test of the bar 2 breakout. It also reversed up from dipping below the bar 5 spike. Although 2 legs down are to be expected, this setup made a tradable long worthwhile, with the plan to look to short a test of the bar 6 high. R8 was a small 2-legged drop following a wedge. The line is not drawn, but the rally up from bar 7 had 3 pushes up test of the bar 6 high. But a 2-legged test up of the bar 6 high was more likely after such a big rally up from bar 7. Bar 8 was the first pullback through a steep trend line and an EMA reversal long. This was tricky in here, as is often the case just before a major reversal. Choppy movement is a reflection of the emotion on both sides, and one side will soon win out. The bearish case is clearly stronger when there is a choppy rally after a major trendline break down to bar 7. Bar 9 was a 2-legged test of the bar 6 high, forming a higher high. It also followed the strong break of the trendline down to bar 7 and the break of a smaller trendline down to bar 8. At least 2 legs down are likely. Finally, it was a failed breakout above a wedge and therefore a second entry. The wedge broke to the downside and failed at bar 8. It then broke to the upside and failed at bat 9 in the opposite direction. Bar 10 is an M2S short after a sharp first leg down. It is also a breakout pullback after breaking below bar 8 and below the EMA. Bar 11 is a double bottom pullback, in this case, a good-looking head and shoulders bottom, forming a high 2 entry and a higher low after a trendline break. It also reversed up before falling below bar 4, so it is a higher low, giving confidence to the bull. Finally, it was a double bottom bull flag with bar 4 and a breakout pullback after 3 pushes down, and it should therefore have at least a second leg up. R12 is an M2B long on the first pullback after a steep trendline break, and it is a breakout pullback after breaking above the January gap. Bar 13 was a small 2-legged correction and a failed low 2, and therefore effectively a high 2 long 2 failed attempts down is the same as a second attempt up. R14 is a wedge pullback test of the EMA and the first pullback after breaking a steep trend line. The market is close to the bar 9 high and may be the top of the first big pullback, lower high in a new bear. However, it could also be just testing the top of a big trading range or a pause en route to a new high. This latter scenario is the least likely after such a sharp sell-off down to bar 11 and the relatively weaker current rally. Remember that the channel up from bar 4 was a target for a pullback, which occurred at bar 11, forming the double bottom bull flag. A channel usually leads to a trading range, so the rally up will likely fail in the area of the bar 9 high and be followed by another move down. Eventually, the market will break out in one direction or the other. First thing that any trader should do when trying a new approach is print out weeks of charts of the time frame and market he plans to trade and see if his setups appear to be valid. When he begins to trade, he should not trade more than 2 contracts, no matter how large his account is. Only after consistently making a profit for several weeks should he begin to increase his position size. However, most traders take many years to become consistently profitable. The most difficult part of trading is deciding whether a setup is good enough to warrant placing a trade. It is especially difficult to do real time when you always feel like you need one more bar to be sure, but once that bar forms, you've missed the best entry. It takes many years of practice to be able to look at a chart and instantly see what is happening, and even then nothing is ever perfectly clear. However, some things are easier to recognize than others, and a beginner is wise to focus on just a couple of setups that are easy to anticipate. Fortunately, there are many setups that are easy to spot and have excellent odds for success. If the chart starts near the lower left-hand comer and is near the upper right-hand comer, and there have not been any bare legs that have dropped below the midpoint of the screen, or if there has been a number of swings with lots of bull trend bars and only small pullbacks, you should buy every high 2 where the setup bar touches or penetrates the EMA. Once long and once the entry bar closes, move your stop from 1 tick below the signal bar to 1 tick below the entry bar. Scalp out half. You can adjust this with experience, and then move your stop to break-even or maybe a tick or 2 worse. Add on at every new opportunity. Most markets are in a strong trend maybe 20% of the time or less. When the market is not clearly trending, look to fade second entries at new swing highs and lows. These days will have several swings lasting 5 to 10 or more bars, and then the trend line breaks, leading to an opposite swing. If the momentum on the move to the breakout is strong, wait for a second entry, which usually comes within 5 bars or so. Once you are consistently netting a couple points every day in the E-mini or 50 cents or $1 in Apple or some other major stock, you should focus on increasing your volume rather than adding lots of new setups. These are the very best setups, and if you trade 25 E-mini contracts and net just 2 points a day, you will make $500,000 a year. If you trade 100 contracts and net 4 points, you will make $5 million a year. Many stocks like Apple, GS, RIM, and SKF can handle 3,000 or more shares without significant slippage most of the time. If you average 50 cents a day on 3,000 shares of just one stock, that is about $300,000 a year. It is natural to get confident after some success, and most traders will start looking to add more setups to their arsenal. Also, they hate sitting for an hour or two while waiting for the best setups when they see lots of profitable scalps unfolding in front of them. The absolute worst thing to do is to start trading barbed wire. These trading ranges typically occur in the middle of the day after you have been watching for an entry for a couple hours. They are usually in the middle of the range near the EMA, and they always look so simple. However, they will damage your account and your psyche. Unfortunately, most traders think that they can figure them out, and they trade them and wonder at the end of the month why they are down a couple of $1,000s. Another common mistake is to look at 1-minute charts. The trades are very easy to spot at the end of the day, but most are hard to trade real time. If your goal is to make money, and that should be your goal, only take the best trades and avoid barbed wire and 1-minute charts. If on the other hand this is just an exciting hobby for you, remember that hobbies cost money, and there may be another one out there for you that is just as much fun and much less expensive. One of the best reversal patterns is a trendline break with strong momentum followed by a 2-legged test that results in a new extreme. The 2 legs to the new extreme, a higher high or lower low, are effectively 2 attempts to re-establish the old trend, despite the strong trendline break, and that failed second attempt has a high probability of leading to a strong reversal that should have at least 2 legs and often results in a new, opposite trend. Finally, trading stocks in the first hour or so is one of the easiest ways to make money trading. Focus on failed breakouts and breakout pullbacks from patterns from yesterday. If there is a strong reversal bar, take the first entry. If there are 3 or more largely overlapping bars, wait for a second entry. After you have about 50 cents to $1 profit, move the protective stop to break-even. Take 1/2 to 1/3 off at $1 profit, and maybe take another quarter off at $2. However, always let at least a quarter of your position run with a break-even stop, or until there is a clear and strong opposite signal, because trends last much further than you would ever think possible. Major reversals. Major reversals reverse a trend that has been in effect for at least a couple of hours and often for several days. The best trend reversal entries have a break of a significant trend line before the setup, because you do not want to enter countertrend unless the countertrend traders have already shown some ability to control the market. Enter on a pullback that tests the trend extreme. The pullback can undershoot a lower high in a new bear or a higher low in a new bull, or overshoot a higher high in a new bear or a lower low in a new bull, the old trend extreme. But if an overshoot goes much beyond the old extreme, the trend has resumed, and you should wait again for a new trendline break. Lower low bar 9 after a trendline break. Goog gap down in figure 15.2, tested the gap in the steep EMA, and broke to a new low. Bar 1 was a good short, a low 2 gap test near the EMA, but the trend was more certain after the breakout to a new low, as evidenced by the two large bear trend bars with small tails. The best trades were the low 2M2S entries at bars 2 and 3. Bar 4 was a second attempt at reversing the wedge, the bear trend channel line, so it was likely to result in 2 up legs and did. The signal bar was a doji, which is a 1-bar trading range, and in general it is unwise to buy at the top of a bear trading range. But this was the second entry in a 3-push pattern and also a failed final flag reversal of the 2 prior small-bodied bars, which almost formed in Roman 2. Bar 5 barely broke a trend line from bars 1 and 3, but bar 7 clearly had strong momentum up, breaking the trend line and the EMA, making traders get ready for a long entry on a test of the bar 4 low. Bar 7 was an acceptable EMA gap short, a double top bear flag with bar 3 and 2 legs up in a bear. Remember, breaking the trend line does not turn the trend into a bull. It is still a bear until after the market tests the low, so you should still be looking for shorts. Bar 8 reversed the low of the day, but the move down to bar 8 was strong, which would require a strong reversal like a strong reversal bar or a second entry. Bar 8 was a bull outside bar, which can be an entry when there are clearly trapped traders. When it is not clear, it is better to wait for more price action. Bar 9 was a second attempt to reverse the breakout to the new low and was a great entry for an expected 2-legged move up, and was the best long setup of the day and easily anticipated after the strong trendline break up to bar 7. Bar 10 reversed back up at 8 cents. 8 cents is tiny for a $500 stock above the signal bar for the bar 9 long and was an excellent breakout test, micro trendline long and higher low, allowing traders to add on above its high. It also trapped longs out, and they will now chase the market higher. You always need to be looking to buy that first higher low after a possible major lower low. Lower low bar 13 in figure 15.3 after a trendline break, and then a higher low bar 17 after a bigger trendline break, not shown but across the highs of bars 1 and 11. Homebuilder's SPDR was in a protracted bear. The first sign of bullish strength were the rebound from bear trend channel line overshoots at the bar 10 low. Bar 11 broke a major bear trend line. The trend line could also be started at bars 2, 3, or 5, and all would be similar and gapped above the EMA. At this point, traders would begin looking to go long on a test of the bar 10 low, either in the form of a higher low or a lower low, but the trend is still down until then. Bar 13 formed a 2-legged lower low, which is often how trends end. Bar 12 was the first entry. It only went 7 cents above the prior bar and is barely noticeable on this chart. But the down momentum was still strong, making most traders wait for more price action before buying. 2 bars later, bar 13 set up the second long entry on the reversal from the new low below bar 10, and it was 2 legs down from the bar 11 surge. This is a perfect setup for at least a 2-legged rally. Bar 14 was the top of a very strong rally and therefore unlikely to be the end of the move up. The odds were very high that the market would test bar 14 and likely surpass it before falling below the start of the rally, the bar 13 low, if it ever gets there again. Bar 15 was a 2-legged pullback, but not a strong buy setup, because bar 14 was a small bull trend channel overshoot based on the highs of the prior 5 bars, and would be likely to have a bigger, more proportional sell-off. Bar 17 was a second leg down and had a high 2 buy setup, and was a test of the breakout that started the rally. It also went a little past a Fibonacci 62% retracement. But don't look at Fibonacci numbers when you trade, because they are rarely any better than just an eyeball estimate of an acceptable level of retracement. It is a 2-legged pullback to a higher low after a lower low, and therefore a possible start of a major bull run. Bar 18 fulfilled the goal of a high above bar 14, and traders clearly took profits. 2-legged pullback to a lower high bar 4 in figure 15.4 after a trendline break. The trend was still up at bar 3 because the trendline break is not yet a reversal. However, there was strong momentum on the move down to bar 3, so smart traders would only buy a strong signal, and instead would watch to see if the market failed again in its attempt to push above the 177 area where bar 2 failed earlier. two-legged pullback to a lower high bar 10 in figure 15.5 after a trendline break. Bar 4 is not a misprint. It was a large gap-up bull trend bar that closed on its high. Amazon was in a strong daily bull but broke the major trendline on the move down to bar 5. The bull is still in effect, and traders will still be looking to buy for a test of the high if there is a good long setup. There was not. Because of the strength through the trendline and EMA, traders will look to short a test of the high, especially a second entry, whether it forms a higher high or a lower high. The rally to bar 6 was strong, but there was no clear second entry on this test of the high. Bar 7 broke a smaller bull trendline, indicating more bearish strength, and then again tested the bars 3 and 4 highs on the rally to bar 10. Bar 10 was 3 pushes up from a sharp rally off bar 7, and this always has to be considered a form of a wedge reversal pattern. Bar 10 also formed an approximate double top bear flag with bar 6, and a second test of the bars 3 and 4 highs. This is as good a second entry short that a trader could hope to find. A double top bear flag made of a small wedge in a two-legged rally to test the trend high bar 4 after a major trendline break, to bar 5. All occurring at a time when traders were looking for a setup to allow them to go short with limited risk. Always make sure to swing part of your position after a major reversal, even if you get stopped out once or twice, because a single swing entry will usually make more money than many scalps. Higher high bars 5 and 7 in figure 15.6 after trendline breaks. Also, a lower low after a trendline break, bar 11. The rally to bar 5 was composed almost entirely of bull trend bars, so a trader should wait for more price action before shorting. Bar 6 broke the micro trendline and then made a two-legged push to a higher high higher than both bar 2 and bar 5, and was a strong short setup and had a bear close. There was also a lower high bar 3 after a trendline break and lower low bar 11 after a trendline break, which was a failed final flag as well. Bar 9 is a perfect example of why the break of the bear trendline does not turn the market into a bull. It was a nice bear reversal, a double top bear flag, 2 legs up, and a failed upside breakout of barbed wire and a bear, all setting up a good short trade. Even though bar 9 was a doji, it is still a good signal bar since it is setting up an entry in the direction of the trend, and there were several favorable factors that give the trade an excellent chance of success. Higher high bar 7 in figure 15.7 after a trendline break. It was also a short entry on a large expanding triangle top bars 1, 2, 3, 4, and 7. Bar 7 was a failed final flag short after the trendline break down to bar 6. Since the expanding triangle top formed over 10 months, traders should expect that the bulls would not give up quickly. However, the bar 7 high should hold if a major move down was to ensue, and that is where the initial protective stop belongs. Bar 8 was a lower high after the sharp sell-off below bar 6 and a great setup to trap the final bulls. It was a perfect breakout test of the short below bar 7. You always must look to short the first lower high after a higher high that could be a major reversal. Once the market dropped below the bar 6 spike down, the protective stop could be trailed above the most recent swing high. Bar 11 was a long entry into an expanding triangle bull continuation pattern. Although that is a great trade, it is not as strong as the other reversals in this chapter. There was also an acceptable short at the lower high that followed bar 3, and the lower high at bar 8, and a good long on the higher low that followed bar 4. There was a break of a steep trend line on the small rally up from bar 4, and the pair of higher lows double bottom bull flag after bar 11. 3 small pushes to a lower low bar 4 in figure 15.8 after a trendline break. Higher low bar 6 after a trendline break, the bear trendline down from bar 1. Bar 6 was the first higher low after a lower low that could be the end of a bear. Higher high bar 9 after a trendline break. The rally to bar 3 broke the trendline, but this alone does not create a new bull. The wedge at bar 3 was a strong short. 3 pushes up bar 4 in figure 15.9, especially since it was near the top of a bear trading range. Also, bar 1 was a lower low after the break of a steep trendline not drawn. In figure 15.10, there was a trend channel line overshoot and reversal bar 12, small wedge top bar 2, lower high bar 4 after a trend line break. Higher low bar 6 after a trendline break. The rally from bar 6 was a second leg up, but it ended in a double top bear flag. Lower low, bar 7, after a trendline break, followed by a higher low at bar 9. Bar 9 was the first higher low after a lower low that could be the bottom of the market. It followed a trendline break. A broken channel and a spike in channel trend often corrects to near the start of the channel here, bar 10, as the market attempts to create a new range from which the next move will break out in either direction. Such a perfect day. If you look at the 5-minute chart on the right in figure 15.11, the shape is unremarkable for a higher low bear trend reversal. But if you look at the price scale on the right, you can see that some of the bars were more than 30 points tall, in contrast to a normal day where the bars might have an average range of about 2 points. This is the market's attempt to put at least a temporary bottom in after the Dow lost 20% this week in the Obama crash of 2008. The market tanked because of fear of Obama's policies, not the subprime mess, but that is irrelevant to trading. It's been clear for over a year that the market should fall below 10,000 in 2008 because it appeared that it might have entered a trading range. There may be a major top in place, and the selling could lead to much lower prices, but a trading range is a more common and therefore more likely outcome. The worldwide fear that Obama's policies that will hurt businesses by increasing regulations and costs, and the fear that there would no longer be an economic leader of the free world, have just sped up the process. Even though the Dow had a range of 1,000 points today, it was still just another day at the office for a price action trader. If you cut your position size down to just 20% of normal because you had to risk about 10 points on each E-mini trade, you could still end the day with more profit than on an average day by using a 4-point profit target. Also, on huge days like this, it is very important to swing part of your position and rely on a break-even stop because there were many swings of 20 points or more. If there is an opposite signal before your break-even stop is hit, exit, take a break, and marvel at the unbelievable profit you just made. Or, if you are an unusually good trader, reverse and repeat the process. Today is Friday and the Dow had been down 200 to 700 points every day this week, so an attempt at a reversal was likely. However, you have to be patient and look for standard price action setups. The chart on the left is a 60-minute chart and bar D. It is also bar 6 on the 5-minute chart on the right, fell through the trend channel line built off bars and C, and then reversed up. On the 5-minute chart, bar 6 formed a huge doji bar after the market fell below the bar 2 to 4 trend channel line. Dojis are not great signal bars, but the market was reversing trend channel line breakouts on both the 5 and 60-minute charts, and the Dow was down 700 points, so a tradable rally was likely. Bar 7 broke above the bear trend line but formed a failed final flag top and 2 legs up, so a pullback was likely. However, the move up from the bar 6 low was violent, so it was likely that there would be a second leg up after a test of the bear trend low. Just patiently wait for a higher low with that much upward momentum. A lower low was not expected. If your break-even stop gets hit, enter again because there is an excellent chance of a very large move up under these circumstances, and it is common for the market to hit break-even stops a couple times before the trend accelerates upward. Bar 10 was a possible bottom since it was a failure of a failed wedge pullback and a breakout pullback, a lower low version following the bar 9 micro trendline false breakout. However, the move down from bar 7 lasted more than an hour or so and was very deep, so a second leg down was probable before the final bottom was in. The move up to bar 11 broke another bear trendline, so the bulls are gaining strength. Bars 8 to 11 illustrate a common pattern in which a failed final flag evolves into a wedge. The flag breaks out and reverses up, as it did on bar 10, and then there is a two-legged rally that is actually a third leg and therefore a wedge. The first leg is the bar 9 top of the wedge. This type of larger pattern then often becomes a larger failed final flag. Bar 12 was a lower low compared to bar 10, and therefore a possible higher low on the day, but the move down to bar 12 had too much momentum, and a test was likely. The bull leg to bar 13 had several bull trend bars and broke another bull trend line. Bar 14 was a good-sized bull reversal bar and a micro trendline breakout pullback, and a higher low compared to bar 12, so this could be the final low, which was. This turned bar 12 into the first strong higher low after bar 6 and an excellent test of that bear low. This was the trade of the day and the one that you needed to be waiting for all day after the strong move up to bar 7. There were many other trades today, but this one was easy to anticipate and it unfolded perfectly. There were trend channel line overshoots on the 5 and 60-minute charts, a huge move up to bar 7, making a higher low likely, a two-legged pullback to bar 12 forming a possible 60-minute higher low, followed by a 5-minute higher low at bar 14 that confirmed the bar 12 higher low. You did not need the 60-minute chart to make this trade. It is here to show that there were longer time frame forces at work here as well, and it is clear from the volume that institutions were paying attention to them. Notice how the market has broken all 4 bear trend lines drawn on the chart and longer ones that were not drawn. At some point, the developing bull trend lines not drawn become more important as the market transitions into a bull trend. Those bull trend lines include the ones drawn across the bar 6 to bar 10 lows, the bar 6 to bar 12 lows, and the bar 12 to 14 lows. Bar 15 was a doji but an excellent signal bar in this context. It was a trend channel line overshoot, not drawn but over the prior few bars in a surge to a new high of the day. The run-up was so sharp and the bar was so large that longs would be eager to take profits below bar 15. Aggressive bears would know this and would be shorting, fully aware that no one on the other side would be eager to buy before seeing a pullback. This is a perfect example of the importance of swinging part or all of your position at a major low. Your break-even stop would have been hit on the long entry from bar 12, but your long from bar 14 would have made 60 points, and even if you increased your scalp size to 4 points, you still would have made as much as you did on 15 scalps. Bar 15 reversed down after a new high on the day. Minor reversal scalps during trading ranges days. If the swings are lasting for only a few bars to an hour or so, and the day is not a trend day, fading new swing highs and lows is an effective scalping technique, and it sometimes offers some reasonable swings as well. The very best of these minor reversals are second entries and wedges at new extremes. One could question taking scalps when there are so many great swing trades, but the reason is simple. If there is a very high probability that you can make 1 point in the E-mini by taking the trade, and the market can handle huge volume, you can make your entire day's profit off just one of these 1-point scalps. Bar 2 in figure 15.12 took out the high of the open, so smart traders will be looking for a second entry short if a breakout pullback long fails, which came after bar 3. The up momentum at bar 2 was strong enough that it is wiser to wait for a second entry to short. Bar 9 was a second attempt up after breaking below the bar 4 swing low, and it was the second attempt to reverse the breakout to a new low. The first was the bar 8 Roman 2, which became a failed final flag. Bar 1, in figure 15.13, is a wedge reversal with a strong reversal bar. Bar 2 is a wedge top. Bar 4 is a doji in a steep decline, and since it might just turn into a 1 or 2 bar bear flag, you need to wait for a second entry to buy. Bar 5 is a reversal up from the second attempt to break out to a new low below low 1. The inside bar that formed the signal bar had a bull close. It was also a lower low after the trendline break created by the move up from bar 4 and a failed final flag. Bar 6 is a low 4 short that reversed after breaking out above the bar 3 swing high. It is also something of a double top bear flag with bar 3, pullbacks in a strong trend. The sign qua non of this approach is that you believe that the chart is in a strong trend. Since most traders will not recognize that a day is trending on a 5-minute chart until after the first hour or two, these trades will usually not be in the first hour. The best setup is a 2-legged pullback to the EMA. Pullback to the EMA usually looks as though it could never lead to much of a with trend move, but invariably, the move will take out the old trend extreme and carry much further than you would ever imagine. It is important to swing part of every with trend entry on a strong trend day, even though that means that sometimes your break-even stop will be hit on the swing portion of your trade. However, the big runs will more than make up for this. At every new setup, you can either simply add back your scalp portion or instead place a full position on top of your current open swing position. Once you scalp out of part, your swing portion is then twice the size of your normal swing, or 3 or 4 times if you keep adding on at every new signal. Most traders would find it easier just to add their scalp contracts back, because otherwise they will have ended up with too many contracts to be comfortable. And discomfort makes it hard to follow your rules. Micro trendline failed breakouts form high 1 long entries in a bull and low 1 short entries in bear, and are also excellent with trend setups. If the entry fails within a bar or two, you then have a failure of a failed breakout, which is a breakout pullback and another reliable setup. After the breakout below bar 2 in figure 15.14, traders would assume that today is a trending trading range day or possibly even a stronger trend from the open day. The bar 4 double top bear flag began the bear trend from the open. By bar 6, traders should be shorting 2-legged moves to the EMA and every low 2 that they see. Bar 6 is an M2S, bar 5 was a small bear bar, ending the first leg up. Bars 9 was a low 2 short, and bar 12 was a M2S, the small bull bar before it ended the second leg up. Neither look good, but you must trust that M2S entries have a very high probability of success during a strong bear trend day. Almost every day there will be stocks that are trending, and they will usually have 1 or 2-legged pullbacks to the EMA, offering great with trend setups and limited risk. By bar 7, in figure 15.15, traders would be looking at this as a likely trending trading range day, and they would buy the bar 7 M2B and the bar 8 breakout pullback, basically Roman 3 bodies. Bar 14 was a failed breakout below the trading range at the close of yesterday, and clearly a higher time frame higher low. And the move up to bar 15 might be leading to a trend from the open day. Bar 16 is a first pullback long based on the down-up twin test of the EMA. It was also a higher low and an EMA gap bar long. Bar 18 was not a good high too because the setup bar was a doji with a down close, and it was setting up too close to the EMA magnet. Also, the move up to bar 17 was parabolic and therefore climactic, and this usually makes a high 2 less reliable. Bar 19 was a 3 pushdown correction to the EMA. Bar 21 was a high 2 with a down-up twin setup and M2B. Bars 1, 5, and 12 in figure 15.16 were clear buys. Bars 8 and 13 were 2-legged pullbacks below the EMA gap bars. Bar 8 was the second test of the bar 5 trading range low, and bar 13 was the second test of the bar 6 trading range high breakout, and both formed a double bottom bull flags. Bar 10 set up a second long entry on a breakout pullback, and a failed expanding triangle top from bars 2, 3, 4, 5, 6, 8, and 9, and a micro trendline long. Note that even though this is a clear bull, bar 6 was a good short because there was first a trendline break down to bar 5. Bar 6 was a 2-legged, wedge rally to a higher high in the top of an expanding triangle, bars 2, 3, 4, 5, and 6. Bar 15 was a breakout test of bar 11. Many with trend setups will look terrible, but you have to trust your read and place your orders, or else you will be trapped out of great trades like so many other weak hands. In a strong bull, you do not need setups to buy. You can buy at the market anywhere and make money, but setups allow you to use tighter stops. This rally has a channel look so when the correction finally comes. The market will likely test the start of the channel in the area of the bar 12 or even bar 8 low. In fact, it fell all the way to 30 over the next 6 months. There was strong up momentum with the first major leg ending at bar 3 in figure 15.17. When there is a strong bull, look to buy a high 2. Bars 5 and 6 were great high 2 long entries, and bar 6 was also an M2B. Bar 7 was the second leg up, and a failed flag breakout that drifted down and broke the major trend line of the day. When the market is no longer clearly trending, it no longer offers great trades. The remainder of this discussion is to remind traders of basic principles, and none of these trades belong in this chapter. The market was now sideways with lots of dojis, and smart traders would avoid this type of price action because there is too much risk of losing trades and not much chance of a big move. Since there was no clear rally in the move down to bar 8, and the bears have been in control for over an hour, it is reasonable to look for a second leg down, a possible bear spike and trading range top. Bar 10 was a small leg up, and bar 12 was a second leg up, and it had a low 2 on its rise from bar 11. Also, bar 12 was a small bar that gapped above the EMA. This is a good short for a second leg down. Bar 13 was a breakout pullback of the bar 9 breakout and a failed bull reversal bar, trapping longs. So what were the high probability trades? Bars 5 and 6 in the strong trend were the best, and the bar 12 short in the now sideways market was also a good trade. This short was a second leg up after breaking the bull trend line, a low 4 and a gap bar in the second leg up from bar 11 with a flat EMA, a breakout test of the short entry below the bar 7 signal bar, and the second attempt to reverse the breakout above the bar 10 swing high. However, only very experienced traders should be considering trades in tight trading ranges, and even most of them would look elsewhere. Do not trade here. Intraday stocks. Trading stocks on a 5-minute chart is fairly easy if you limit yourself to 3 types of trades: EMA pullbacks and strong trends, clear and strong reversals after major trendline breaks, and first-hour failed breakouts and breakout pullbacks of patterns from the prior day. The best trades are on strong trend days where most of the bars are on one side of the EMA, and there are only a couple of EMA pullbacks during the day. Entering on those pullbacks, especially if they are M2B or M2S setups, is probably the single best stock day trade that you can make. If you follow a basket of about 5 stocks with large volume, over about 5 million shares traded each day, and an average daily range of $3 or more, then you should be able to make 1 or 2 trades every day where you can net $1 on the scalp portion of your trade, and usually more on the swing portion. After entering, place a protective stop beyond the signal bar. You rarely will have to risk more than $1 and usually under 60 cents, until the entry bar closes, and then move the stop to just beyond the entry bar. Once the stock moves about 60 to 80 cents in your direction, move the stop to break-even, and maybe a few pennies worse. For example, if you bought at 120.10 and the stock hit 120.80, move your stop to around 120.07. After you exit half or so of your trade on a limit order at $1 of profit, rely on your break-even stop. Trail your protective stop beyond swing points on the 5-minute chart and take a little more off at $2 profit. Never exit the final portion until your stop is hit or unless a clear and strong opposite signal develops. There are several examples of this type of trade in the prior section. The second type of trade is a trend reversal, but these are trickier for beginners because most reversals fail, and beginners tend to be overly eager and enter on weak setups. For a reversal, there has to be a strong break of a major trend line, with this first reversal leg showing a lot of momentum and having a strong reversal bar. You will then wait for a test of the trend's extreme and enter on a successful test, a lower high or higher high in a market top, or a higher low of a lower low in a market bottom. You want the signal bar to be a strong reversal bar. If the setup does not have every one of these components, do not take the trade. The stop management is the same as for the trend trades described above. The final type of trade requires you to look for a pattern on yesterday's chart, like a flag, swing point, or trend line, and then today look to enter on a failed breakout or a breakout pullback. The high or low of the day commonly occurs on these opening reversals. The market has been drifting down for several hours and has yet to pull back to the EMA, so this is a very strong bear trend. The best trades are the shorts on bars 2 and 10 in figure 15.18. The bar 2 entry price is 169.88, and the initial stop is above the entry bar at 170.38. The entry bar is an outside-down bar, and you should place the stop above its high as soon as you enter, before the bar closes. This is reasonable because it defines your risk, and you would not want to be short if the market immediately reversed above the high of the bar. If it was not an outside bar, you would place your stop above the signal bar. The initial risk here is 50 cents. Bar 5 was a high one that ran 7 cents above your short entry price, but you would not yet have moved your protective stop down because your largest open profit was only 38 cents, and you need to give your trade time to work. Typically, you should not move your stop to break-even until there has been about 60 to 80 cents of open profit. On bar 6, you would have been able to exit half of your shares with $1 profit using a limit order. The bottom of bar 6 was 1.07 below your entry price. As you can see by the outside-up nature of the bar, lots of traders likely covered part or all of their shorts as well. At this point, move your protective stop to break-even or maybe a few pennies worse. 170.91 is reasonable, since Opal rarely runs stops by more than a penny. And do not exit unless there is a clear and strong reversal, which is unlikely on such a strong bear trend day. Expect pullbacks to scare weak shorts out. For example, the rally to bar 9 hit break-even stops to the penny, 170.88, and then reversed back down. If you were stopped out, you could short again on bar 10, off the bar 9 EMA test and breakout test. Bar 10 shows that the breakout test accomplished its goal of scaring traders out, because clearly lots of shorts came back in. If you let yourself be stopped out, you would now be short again, but at 41 cents worse. However, in a trend from the first bar bear with only a couple of one-bar rallies at the bars 2 and 3 lows in figure 15.19, and those rallies never even got close to the EMA, there was no significant prior strong buying. Simply breaking a trend channel line is not a sufficient demonstration of bullish strength, and until that strength is present, any countertrend trade is a scalp, which is a losing strategy against a strong trend. If you think that the market fell too far, too fast, and was due for a rally, look at the chart below. The bar numbering is the same. Once the wedge bottom failed, the market fell another $6. Never trade countertrend unless the setup is perfect. It needs both a prior strong trendline break and a strong reversal bar. Every day, you should be examining the chart throughout the day and especially in the first couple of hours to determine if the day is a trend day. The major types were described earlier. If it is, you should not be trading countertrend. A trend from the open day like this in figure 15.20 is the single easiest trend day to see. You would have suspected it by the third bar of the day, a large bear trend bar, dropping far from the open, and you would be very confident by the time the market broke below bar L. The bar 1 rally was a big bull trend bar, and it broke a trend line. An eager trader might then buy above the bar 2, bar 3, and bar 4 reversal bars, thinking that the bulls showed adequate strength during that trendline break. However, the market has been below the EMA since the third bar of the day, and traders should remember that on trend from the open days like this, the first rally to the EMA usually fails and then tests the low. Don't convince yourself that the market has gone too far and is due for a rally. By definition, you are thinking countertrend and looking for countertrend scalps on a strong trend day. You are afraid to sell near the low and instead are hoping for a trend reversal, which is a low probability bet. Do the math. Most long scalps will fail, and the amount you lose on each one will be too great to make up by the eventual winner or two. On the other hand, GS did not have a tradable M2S all day, so most beginners eager to make a profit should look elsewhere for the best trades today. However, an experienced trader would be shorting even the tiniest pullbacks all day long, relying on the typical pullback sequence to bail him out if a pullback went further up than he thought was likely. Every type of first pullback is usually followed by a test of the trend's extreme here, the low of the day. Always look for breakout pullbacks and failed breakouts. Bar 1 in figure 15.21 is a failed breakout short. Bar 2 is a reversal up from a test of today's low, and it was a second attempt to sell off below yesterday's trading range, failed breakout. When 2 attempts at anything fail, it is likely that the market will do the opposite here, rally. It is also a wedge. Bar 3 is a failed breakout above yesterday's high. Bar 4 failed in its breakout above a bear trend line and above the EMA. Bar 5 was a strong reversal bar up from a gap below yesterday's low, a failed breakout below yesterday's low. Bar 6 was a breakout pullback from the opening rally that broke above yesterday's trading range. It was also a higher low at the EMA. End of book.